And given the power of finance, what we do collectively will have broader repercussions to the global community and also our future generations. So with these issues and questions in mind, I look forward to the very inspiring discussions today and also the collective wisdom that will be brought by some of the brightest minds in global finance today. And I look forward to it, and I hope you will all enjoy the summit today. Thank you very much.
Thank you very much, Mr. Yu, for setting the stage for us today. And now we welcome a very special guest to the stage, the Chief Executive of the Hong Kong Special Administrative Region of the People's Republic of China, Mr. John Lee. Please.
Deputy Director Yin Zhonghua of the Liaison Office of the Central People's Government in the Hong Kong SAR, Commissioner Liu Guangyuan of the Office of the Ministry of Foreign Affairs in the Hong Kong SAR, Mr. Eddie Yu, Chief Executive of the Hong Kong Monetary Authority, ladies and gentlemen, distinguished guests, good morning, and welcome to the Global Financial Leaders Investment Summit, or, as I like to call it, the Hong Kong On Stage Again Summit, the Back to Business stage, the Doing Business with the World stage, Where Belong stage, with you, financial, investment, and business leaders from about 20 countries and economies. Whatever we call it, your presence today puts a heady exclamation point to this welcome gathering, as I'm sure it did last night too. I hope you enjoyed the dinner at the West Kowloon Cultural District's M+ Museum and the performance from the Hong Kong's own Metropolitan Youth Orchestra. The medley of songs performed by the orchestra brilliantly reflects the spirit of Hong Kong. You'll be hearing more about that spirit throughout the summit. Navigating beyond uncertainty is our theme today. It's a refrain that could well speak for the world at large right now. We are, all of us are, living through uncertain times. The world is working its weary way out from an unprecedented pandemic, now nearly 3 years in the making, and the unmaking of our economies and communities. Political turmoil is rife and geopolitical tensions rising. Inflation is soaring, the global economy weakening. And yet, despite the troubled world we live in, you apparently don't quite feel it from Hong Kong. Our streets are safe, if more crowded than you may be used to. More to the point, social disturbance is clearly in the past. It has given way to stability, to growing business and community confidence in Hong Kong's future. Law and order has returned. The worst is behind us. That's thanks to the long-established certainties and unique advantages. I'm talking about the one country, two systems principle that has shaped and rewarded Hong Kong for 25 years now. One country, two systems is the unwavering cornerstone of Hong Kong. As President Xi Jinping said, marking the 25th anniversary of the Hong Kong Special Administrative Region's establishment in July, one country, two systems is here to stay, and we must adhere to it in the long run. For good reason. for all kinds of good reasons. Just 2 months ago, Canada's Fraser Institute again ranked Hong Kong the world's freest economy. Our embrace of capitalism, buttressed by the common law system, remains as strong as ever. We have adopted a low and simple tax regime, safeguarded the free flow of capital, and maintained our long-standing status as a free port. Under one country, two systems, the rule of law is sacrosanct in Hong Kong. The judiciary exercises its power independently. Fundamental rights and freedoms, including freedom of speech, of the press, of assembly, are enshrined in and protected by the Basic Law. The Basic Law also stipulates that the provisions of the International Covenant on Civil and Political Rights as applied to Hong Kong shall remain in force. That's not going to change. One country, two systems ensures matchless connectivity and opportunity with our country and with the world at large. Hong Kong's seamless connection with the mainland affords Hong Kong advantages available to no other economy. Hong Kong remains the only place in the world where the global advantage and the China advantage come together in a single city. This unique convergence makes Hong Kong the irreplaceable connection between the mainland and the rest of the world. As the center of economic gravity in the world shifts eastward, the mainland, along with fast-growing economies throughout the region, will be a major engine of global growth and an abundant source of economic opportunities. Hong Kong is perfectly positioned to reap the enormous benefits of this irreversible trend. Hong Kong has the talent, infrastructure, and know-how to help mainland enterprises and capital go abroad while attracting international enterprises and capital into the region. That brings me to another certainty: Hong Kong's status as one of the world's leading financial centers and China's major international financial center. In 2020, our financial services contributed $76 billion. That's 23.4% of our GDP. Hong Kong has been the world's #1 IPO venue for 7 of the last 13 years. Hong Kong is also one of the world's leading biotech fundraising hubs. The total market turnover on Hong Kong Stock Exchange last year reached a record $5.2 trillion. Our banking system held assets equivalent to about 9.4 times of our GDP in 2021. Last year, our insurance sector ranked first in Asia and second in the world, with assets under management of more than $4.5 trillion. 2/3 of that funding was sourced from non-Hong Kong investors. Hong Kong is also a leading bond hub in Asia. And for the past 6 years in a row, we've been the world's largest center for arranging Asian international bonds. We were the first Asian government to issue 30-year and 20-year green bonds denominated in US dollars and euros, respectively. These are not just numbers. They demonstrate Hong Kong's immense strengths when it comes to financial services. We were, we are, and we will remain one of the world's leading financial centers. And you can take that to the bank. Hong Kong is certain to scale new heights. Charting a brighter tomorrow for Hong Kong is the theme of my policy address, which was delivered just 2 weeks ago. In it, I introduced a series of major initiatives to raise our competitiveness, create impetus for growth, and expedite Hong Kong's progress to prosperity. I should highlight that the Hong Kong SAR government, under my leadership, will take a result-oriented approach. We will focus on the outcome of policies rather than laboring away on concepts and procedures. For businesses and investors, that means we will act as leader, enabler, facilitator, and even partner in development. We will be proactive in attracting strategic enterprises and top talents to Hong Kong. How will we accomplish that? Let me highlight 3 of our new initiatives. First, we will establish a new Hong Kong Investment Corporation to optimize the use of Hong Kong's fiscal reserves and steer economic development. A co-investment fund of 30 billion Hong Kong dollars, equivalent to $3.8 billion, will be set up to attract companies to Hong Kong and invest in their business. Second, we will put in place an array of new initiatives to help enterprises, investments, and innovative professionals build a base, a home in Hong Kong. Our new and dedicated office for attracting strategic enterprises will offer special facilitation measures and tailor-made services to strategic enterprises from all over the world. Third, we will provide one-stop service for incoming talents through our new talent service unit. From around the world to pursue their careers in Hong Kong. That includes working graduates from the global top 100 universities and those earning over $320,000 a year. Hong Kong has much to offer the world. We are blessed with traditional strengths. Located at the heart of Asia, we are within 5 hours flying time of half the world's population. We have the world's business air cargo hub. We are rated amongst the easiest places in the world to do business. We are one of the world's most preferred seats of arbitration. We are the only Asian city with 5 universities in the world's top 100. Hong Kong features prominently in China's national strategies, including the National 14th Five-Year Plan, the Greater Bay Area Development, and the Belt and Road Initiative. The 14th Five-Year Plan supports Hong Kong's development in 8 major areas. These include, for example, reinforcing our position as an international financial, trade, shipping, and aviation center. One area I'm pleased to highlight is the development of Hong Kong into an international innovation and technology hub. Before year's end, we will publish our INT development blueprint for the future. It will cover major INT policies, including infrastructure, reindustrialization, our talent pool, and the development of a smart city. Then there is the Northern Metropolis. Our newest growth engine is situated in Hong Kong's northern region. It will take up an area about 1/3 the size of Hong Kong and house about 1/3 of our current population. The Northern Metropolis will become a new international INT city, an urban-rural development featuring quality housing, green and sustainable surroundings, prominent arts and cultural clusters, and a healthy balance between work and lifestyle. Its far-reaching potential will radiate beyond its geographical boundary with Shenzhen. It will create boundless opportunities with Guangdong while contributing to the overall development of the Greater Bay Area. We will also enable the continued growth of our cultural industries. Central to that is Hong Kong's rise as an internationally recognized East-West arts and culture hub, a sophisticated global city offering world-class arts, entertainment, and lifestyle 24/7. Yes, we are opening once again for the pure business of pleasure, the pleasure of hosting and entertaining a world of visitors and travelers, arts and culture devotees, food, wine, and pub aficionados, theme park enthusiasts, sports and leisure lovers, holiday hikers, and more. You had a taste of our East meets West arts and culture last night. I invite you back to linger at the Hong Kong Palace Museum. Opened in July, it features more than 900 dazzling pieces of artifacts and treasure from the world-famous Palace Museum in Beijing. And you want to stick around for the weekend and the return after 3 long years of the Hong Kong Sevens. Yes, rugby too is back, promising a long and memorable weekend of hard hits and roaring referee on the pitch and in the stands. Join us. Feel the spirit of Hong Kong on this marvelous Sevens weekend. Ladies and gentlemen, as have many other major cities worldwide, Hong Kong has been through ups and downs over the years, but our resilience remains remarkably unmatched. Consider, since 1997, we have overcome such major challenges as the SARS outbreak in 2003, the global financial crisis in 2008, most recently, disturbances and violence in 2019. Yet, our financial system has never buckled, never wavered. Like Hong Kong itself, it remains strong, sure, and enviably secure. Hong Kong always bounces back, better than ever. We have full confidence in its tenacity and its future. We are already seeing encouraging rebound as we will continue to lift our COVID restrictions. I would like to thank the Hong Kong Monetary Authority for organizing this seminal 3-day Global Leaders Investment Summit, or the Hong Kong On Stage Again Summit. I know you will make the most out of the panel sessions and discussions. After all, they are led by some of the world's brightest minds in finance. And I wish you all the best of Hong Kong's business and investments in the coming year. Before I close, I would like to tap into your success stories. Ladies and gentlemen, you are among the world's most successful business people and investors. You know full well the equation to the most promising investments: opportunity and timing. Good investors focus on tomorrow as much or more than today. They look for prospects touching bottom, for opportunities soon to soar. Look at Hong Kong. I can tell you, the worst is behind us. Opportunity and timing are right here, right now in Hong Kong. This is the moment you have been waiting for. Go for it. Get in front, not behind. Thank you. Thank you all.
Thank you very much. And as Mr. Lee said, you can take that to the bank. The only problem you're going to have in Hong Kong is trying to decide which bank. We have so many established here in Hong Kong. Now, to this day, international investors still find it challenging reading the signals coming out of China. Questions about market reform, opening up, and the long-term investment proposition for China continue to divide opinions. Now, fortunately for us, Eddie Yu from the Hong Kong Monetary Authority has sat down with the leadership of China's top 3 regulatory bodies. Now, the timing couldn't be better, given that China has just wrapped up the 20th Party Congress that will set the direction for the nation for years to come. So we are fortunate that he is having that discussion. So today, we can take some policy signals from this event and get a better outlook on China's macro and policy environment to come. So we are going to start the discussion with the regulators with Governor Yi Gang from the People's Bank of China. Please.
It's a great honor to have Governor Yi Gang from the People's Bank of China here today to talk to us about China's macroeconomic and monetary policy developments, financial market opening up, and also Hong Kong prospects as an international financial center. So, Governor Yi, let's start with a broad picture of the macroeconomic environment. How do you see the recent economic conditions in China?
I should say that the Chinese economy has remained broadly on track, despite some challenges and downward pressures. The Chinese economy has proved to be quite resilient. In Q3, the GDP grew by 3.9%, up by 3.5 percentage points over the second quarter. The job market remains stable, with a surveyed unemployment rate posting 5.5% in September. Thanks to a bumper grain harvest and a stable supply of coal and electricity, inflation remains subdued. The CPI increased by only 2.8% year-on-year in September, and the PPI increased by 0.9% year-on-year.
Well, COVID obviously has a very profound impact on global economic growth. And against this backdrop, what are your views of China's economic growth potential?
I expect China's potential growth rate remain in a reasonable range. China has a super large market, as there is still much room for urbanization, and the demand of middle-class consumers is still on the rise. Thanks to a large group of engineers and skilled workers, China has built a full-fledged modern industrial system and a high-quality infrastructure network. What is more, technology innovation in China is also on a good trajectory, and hopefully the structural reform will continue to fuel economic growth.
Well, Governor Yi, I fully agree that China's growth potential will be very promising despite the short-term fluctuations because of COVID. Now, monetary policy also plays a part in promoting growth. In the face of the various challenges this year, what's the role of monetary policy in supporting stable economic growth in China?
China's monetary policy stays accommodative to support the real economy. This year, to better support economic growth, we have calibrated monetary policy so that it would provide ample liquidity and lower financing costs. In September, broad money M2 grew by over 12%. Social financing and new renminbi loans both grew by around 11%. Currently, the bank time deposit is in the range of 1 to 2%, and the bank loan rate is 4 to 5%. The financial market makes an efficient allocation of resources. Meanwhile, we try to utilize structural monetary policy tools, providing financial support to key areas such as agriculture, small and medium-sized enterprises, as well as green development. Right now, we are also working on supporting investment in capital expenditure and infrastructure. It will show up in Q4 data.
Well, let me now turn to the RMB exchange rate, which has recently drawn some attention. How do you see the trend of the RMB exchange rate?
We follow a flexible and by and large market-determined exchange rate regime with reference to a basket of currencies. Since the beginning of the year, thanks to sound long-term fundamentals of China's economy, the renminbi remained relatively stable against a basket of currencies, with some depreciation against the US dollar and somewhat appreciation against other major currencies. In the future, we will keep on with the market-determined exchange rate regime. The renminbi exchange rate will continue to remain relatively stable at a reasonable and appropriate level, maintaining its purchasing power and keeping its value stable.
Well, Governor Yi, I think the audience today are very keen to understand what the 20th Party Congress means for them. In your view, how can China's financial industry achieve the institutional opening up that was mentioned in the report to the Party Congress?
Reform and open door policy will continue. To expand institutional opening up, we need to participate in actively international discussion on rules, regulations, and standards setting. We will continue to improve the pre-established national treatment and the negative list approach. We will also continue to improve business environment, protecting property rights, those of intellectual property right in particular, and facilitate investment in financial markets.
Well, let's now turn to another key area of focus for foreign investors, China's property market. What measures has the PBOC rolled out to support the property sector, and what are your thoughts on the outlook?
China's housing sector is linked to a lot of upstreams and downstream industries. Housing is a local market. The city government plays an essential role in stabilizing housing market in its location. To support the healthy development of this sector, we have cut mortgage rates, lowered down payments, and encourage banks to introduce special lending program for developers to ensure the timely completion of unfinished housing projects. Recently, sales and lending of real estate sector have seen marginal improvement. With ongoing urbanization in China, we hope the housing market can achieve a soft landing.
And finally, the PBOC and the HKMA, we've been working very closely together in the development of Hong Kong's offshore RMB business and also in enhancing the financial connectivity between the mainland and Hong Kong. How do you envisage Hong Kong's status as an international financial center and its role as a gateway between mainland and global financial markets?
Hong Kong is and will continue to be an important international financial center, connecting the mainland and the international markets. In recent years, Hong Kong's economy and the financial system have shown remarkably resilience despite disruptions. Hong Kong has a great potential in deepening connections with the mainland financial market, financing and investing under the Belt and Road Initiative, fintech, and green finance. To support Hong Kong's development, the People's Bank of China will continue to help Hong Kong maintain a law-based, open, inclusive, and enabling business environment and enhance its status as an international financial center.
Thank you, Governor Yi. Please join me in thanking Governor Yi for sharing his perspective. I fully agree with Governor Yi that the continued opening up of China's financial markets, global fintech adoption, and green and sustainable finance will present huge opportunities for the future development of the global financial system. Thanks very much, Governor Yi.
We now go to views from Vice Chairman Xiao Yuanqi from the China Banking and Insurance Regulatory Commission on views on China's banking sector.
Today, I'm very honored to be joined by Vice Chairman Xiao Yuanqi from the China Banking and Insurance Regulatory Commission. And he will talk about the impact of the property market slowdown on China's banking sector and also the longer-term prospect of Chinese banks. Thank you, Vice Chairman Xiao, for making time to talk to us today. Well, let me first start with the property sector, which has been a key focus of foreign investors, especially after the defaults of several large property developers. Given the importance of the property sector in the economy, how will you assess the impact of the property sector slowdown to the banking sector?
Thank you very much, Chief Executive Yu. I'm very glad to attend this very important gathering hosted by Hong Kong. I'm also very glad to have this chance to share some views about Chinese banks. Thanks for the question, very good question. That's what we are concerned about. The property sector plays a very important role in the economy. We pay close attention to its development. From the banking side, our supervision data shows that the total exposure to the property sector for the banks is, I think, is at a reasonable level. It's about 26% of the total loans. For the small and medium and small-sized banks, the outstanding loans to the property sector is less than the large banks. For those banks, because for the long term, we encourage them to do their business locally and to serve the micro and small businesses. So some of the small banks, their lending to the to the small business, to local market, account for more than 90% of their total loans. And we also require them to comply with the concentration rules and to avoid the lending to big companies. We have the large exposure limitations. You are very familiar with that. In general, the property sector now is, I think, is stable. It's stable, and we are confident that the exposure for the banks to the real estate market is still very low. Non-performing loans to the property sector for the banks is about 1%. 1%. It's even less than the average level. Another point is that the majority of the lending to the real sector, to the property sector, is the home mortgage loans. It accounted for about 90%. 90% of them are home mortgage loans. Home mortgage loans is in part good quality, and the majority of the home mortgage loans are for the first house purchase. It's generally with good quality. Traditionally, Chinese banks, when the Chinese people have the tradition, they do not want to default. So from our statistics, for the past 20 years, the default rate for the home mortgage loans is less than 0.1%. It's less than 0.1%. So it's very low.
Well, Vice Chairman Shao, let me now turn to the next topic about the development of Chinese banks, especially about cross-border expansion. As China's financial sector continues to open up, we're also seeing Chinese banks expanding their footprint internationally. So what are your thoughts about the longer-term development of China's banking sector, including in the international market? And how should Chinese banks raise their game and increase their competitiveness globally?
Yes, in the Chinese financial market, the foreign participants have been playing a more and more important role. I give you several figures. Foreign banks have set up 41 legal entities at the subsidiaries here, and more than 116 branches in mainland China. And recently, a large number of insurance and wealth management companies have set up. Those insurance companies and wealth management companies are owned by foreign capitals, and the foreign investors are in charge of those companies. We particularly encourage foreign capital to have cooperation and collaboration with the Chinese counterparts, or they can, we in some specific areas with the wealth management, the non-performing loan coping, dealing, and transferring techniques. And also in insurance side, we hope that they can provide some insurance techniques about how to assess the cycle. Those specialists, they can take different forms of participation. They can have their subsidiaries 100% of the ownership, and they can set up branches, and they can also acquire some ownership with the Chinese banks, Chinese insurance companies, and the Chinese wealth management companies. They can take different forms. About Chinese banks overseas expanding, they do have a number of banks, mainly the Big Four, have overseas presence, including branches and subsidiaries in some countries. But the total assets for those banks overseas is about 15 trillion yuan, equivalent to 2.5 trillion US dollar. Still a small percentage in comparison with total assets of Chinese banks is more than 400 trillion yuan. So it's about 3.5%. So in terms of the overseas assets, the percent total assets of Chinese banks is still small, 3.5%. As a regulator, we support the Chinese banks to go abroad to do their business. But we have some reminding for them. For example, they need to well serve their customers to achieve commercially sustainable development, to know what the customers need, to know what the local economy need. Because to go to overseas, each regions, each locations are different. Customers are different. Their needs are different. So the first is to know what the customers' need is. Ensure that the local customers' need could be met. The second is to very important is to comply with the local or the host authorities' regulations and also international standards, practices. In different locations, regulations and our supervisory rules are different. Even the supervisory methodology, techniques are different. So they need to adapt to those requirements to in compliance with the local monetary requirements. So that I think they should do so at any time in any place to ensure that the compliance risk is under control. The third one I think is to develop risk management framework and to enhance the risk management capabilities to ensure the quality risk, the liquidity risk, strategic risk, and also the market risk, any risks for the banks. And also the social responsibilities is important to do more climate change, to be more supportive for the green finance and the inclusive finance. For Chinese banks, we encourage them to attract talent for senior managers, particularly from all backgrounds, particularly those talents have local experience, have international experience to help banks to up their games, to more adaptive to the international market, to local market. Those are very important. When I have the prudential meetings with the boards or the senior managers of the banks, I always remind them to have local or international talents come to the board, to senior manager positions, to diversify the composition of the senior manager team. That will benefit for them going abroad more prudently. Yeah.
Thank you very much, Vice Chairman Xiao. It's a great discussion. My own take is that Chinese banks' risk exposure to the property sector are relatively limited and the risk is manageable. And of course, there will be near-term headwinds, but the Chinese banking industry, as I see it, will continue to play a very important role, not just in supporting industries domestically, but as you said, they will continue to expand their global participation in the way that you described and with your guidance. Finally, I would like to thank Vice Chairman Xiao for sharing his insights. I'm sure that our audience will benefit from it. Thank you very much, Vice Chairman Xiao.
And now, going to the third of our three people from the regulatory bodies in China, we welcome views from Fang Xinghai, who is the Vice Chairman of the China Securities Regulatory Commission, to talk about recent developments, including the opening of China's capital markets and a special role for Hong Kong.
I'm very honored today to be joined by Vice Chairman Fang Xinghai from the China Securities Regulatory Commission. He will share with us his perspective on the direction of market opening and also the role of Hong Kong. Thank you very much, Vice Chairman Fang, for making the time to speak with us today.
Good to talk to you, Chief Executive Yu. Thanks for the invitation.
Let me first start with the topic of market access, which is of great interest to our audience today. Despite COVID, in the last few years, we are seeing the continuing opening up of China's financial market, including the continued expansion of the various connections between the mainland and Hong Kong, the removal of foreign ownership limits, and also other enhancements. In fact, a lot of progress has been made in the security sector to allow foreign firms to play a much bigger role in the Chinese market. For example, the removal of foreign ownership restrictions on futures, securities, and also fund management companies. How do you see the prospect of these companies' business in China?
Well, first of all, we opened up our capital markets because that is good for China. We need high quality institutions to play in this market. I mean, China has a huge market and we have a lot of investors, but we still do not have enough high quality institutions, like securities firms, futures brokers, fund managers. So by attracting first-class international players into the market, it's very good for China. And we also have a vision that opening up our markets to international participation will be good for the rest of the world. China, will remain a major driver of economic growth for the world. And we want to share our growth with international participants. That is our vision. That is President Xi's vision. We want to share China's growth with the rest of the world. So with these in mind, our opening up policy is on a very firm foundation. And happily, we have seen very enthusiastic response from international institutions. Many of them have already come into our market, and many of them are in the process of preparing and applying to come into our market. We welcome them all. And for those who have been here, I can say most of them have done very well. Their progress in China has exceeded their plan, exceeded their expectations. So we continue to welcome them in.
Thank you very much for your very upbeat explanation of your policy. Next, I would like to focus a bit more on a topic that is closer to home. You recently spoke about the CSRC's new initiative to strengthen mutual access between mainland and Hong Kong's financial markets, including, for example, broadening the scope of the Stock Connect, and also the introduction of the mainland government bond futures in Hong Kong. How do you think these measures will enhance the appeal of Chinese and RMB-denominated assets to foreign investors? And what are the implications for Hong Kong? This is something that, of course, understandably, I'm interested in.
Yeah, sure. At the CSRC, we see Hong Kong as a very, very important international financial center for China. And of course, for the rest of the world. China wants to develop what we call a high-quality economy, right? And for a high-quality economy, you must have a high-quality capital markets. And so we are here at home, we are full speed ahead in terms of building up a high-quality capital market. But that takes some time. And Hong Kong is already a high-quality capital market. So for China's economic growth, we need Hong Kong. Hong Kong can play a very important role in help grow the Chinese economy. And so because of that, the CSRC is fully behind our central government's policy of grow the Hong Kong financial market even more and make it even a stronger financial center. And that is why about a month ago, or a little bit more than a month ago, I, on behalf of the CSRC, announced 3 major policies to support Hong Kong's growth as a financial center. Among these, I think 2 of them are extremely important. One is, to allow the Connect to cover truly international companies that are that are going to be listed in Hong Kong. Some of them, of course, are already listed in Hong Kong. And that would allow mainland investors to access these international companies. So that will help a lot Hong Kong's ability to attract these major international companies to list in Hong Kong. The second policy is also very important. Is the relaunch, I would say, of the Treasury, the Chinese Treasury bond futures market. Chief Executive, you just mentioned that Hong Kong has this vision to become an offshore RMB financial center, right, where international investors can access RMB assets in Hong Kong. And we support this vision. So with that, Treasury futures market, Treasury futures contract being traded in Hong Kong, that will help a lot the international investors' risk management. And that will also, by itself, help enhance the entire financial RMB financial market in Hong Kong. It will help pricing and so forth. So these are very important policies. The third one is to allow Hong Kong to set up what we call RMB counter in the stocks listed in Hong Kong. So for these large stocks, they will have both RMB trading as well as Hong Kong dollar trading. So these 3 policies put together, I believe, will help Hong Kong quite a lot in terms of realizing Hong Kong's vision of becoming an even more important financial center. And that would also attract more international investors to come to Hong Kong and invest into these RMB assets. Now, let me add one thing. In order for Hong Kong to become a major offshore, or maybe even the most important offshore RMB financial center, I think ultimately it will depend on how successful the Chinese economy will be, right? And on that, I'm very confident. International investors should read more carefully about the work report that President Xi delivered in the recent 20th Party Congress. There, he re-emphasized the centrality of economic growth in the entire work of the party and the country. And that's very significant. And that will, it has been the case in China, and it will continue to be the focus for China for the foreseeable future. We are fully focused on economic growth. And also, but then people would ask, how do you grow the economy, right? And it's simple. Our past 40 years has already pointed the direction, which is market-based reform and opening up to the rest of the world. So President Xi, re-emphasized the centrality of the market mechanism in allocating resources in his work report. And he also said pointedly at the end of the Congress, there was a press conference. I hope people noticed that. Right? There's a press conference where he restated that China's door of opening up can only be bigger and bigger going forward. And Hong Kong will play a very important role in the overall opening up of China's economy, as well as, of course, the Chinese financial sector.
Thank you for this last comment, especially about the centrality of economic development in President Xi's work report, and also his emphasis on the market mechanism and the continued opening up. I think these are very, very important messages for our audience today to take away, and for the broader audience to really understand. That's extremely important.
Let me also add, I deal with international investors quite a lot in my daily work, right? And I'm afraid some of them have read too much the international media report about events in China. Because a lot of media reports, they, let me put this way, they really don't understand China very well. And they have a short-term focus. And I would advise, the international investors to find out what's really going on in China and what's the real intention of our government by themselves. Don't read too much of these international media.
and I think today's communication with you will help a lot in extending this direct message from Beijing to the audience here. So thank you very much, Vice Chairman Fang.
Sure.
And I'm sure that our audience will be benefited from your insights. But my own take is that, well, we're faced with very uncertain external environment. We're bound to see short-term market fluctuations, but that will not reverse the long-term appeal of China's capital markets or China's opening up, like what you just said. And Hong Kong's unique role in connecting the world and the mainland will continue and remains very important. And there will be new exciting opportunities for us. I think that's an important takeaway.
I totally agree with you. Don't bet against China and Hong Kong.
All right. Okay. Thank you very much, Vice Chairman Fang.
Sure.
Okay. Thank you.
Talk to you later.
All right, and thank you again, Mr. Yu, for putting that collection of views forward. Those are exactly the kind of views that we need going forward to be able to navigate through uncertainty. So we're very fortunate to have them. We are going to take a very brief pause to let the chief executive take his leave. He has other pressing duties he needs to attend to. So once again, Mr. Lee, we thank you for joining us today. And you take care of Hong Kong through this typhoon. Thank you very much for joining us today. Thank you, Mr. Lee. While we begin to effect a transition here on stage to move to the next phase of what we're doing, I'm going to let some of you in on a little bit of real Hong Kong insider that you need to know. If you know this thing, people will know that you've got, you're kind of a little bit of a Hong Konger yourself. Right now, there is a typhoon raging outside, not the metaphorical one about the markets, but an actual typhoon. And here in Hong Kong, we have categories of typhoon. Now, for those of you that want to track what's going on, you Google HKO for the Hong Kong Observatory. At the top of the front page, there will be a symbol and a number. And the number is what you are looking for. T1, nobody cares. Hong Kongers, ignore it. T3, things are getting interesting. There's no T2, nobody knows why, nobody cares. So T1, nobody cares. T3, things are getting interesting because the next level up is T8. What happened to T4, 5, 6, 7, 7, 8, 9? I don't know. Again, nobody cares. But T8 is when it gets interesting. That is when schools get closed, people don't have to go to work, but good news, the cinemas and the malls stay open. So first thing in the morning, all the seats are available for booking. As soon as the T8 gets declared, all the movies are sold out all day across Hong Kong. So if you want to be a real insider, track the Hong Kong Observatory and you'll be able to see what's going on with the typhoon because you might get lucky for a T8 today. Just to finish that off, if it goes to T9 or T10, that's when things get serious. And people say, whoa, this is the real deal. And if you're a lover of intense weather like I am, try on a T9 or T10 for size sometime. It's an amazing thing to see. And with that, we are ready to proceed to our next panel, and we are going to be discussing navigating through uncertainty. Our panelists coming up here today are the captains of the biggest financial ships on the seas. Not even the ships, they are the commanders of entire financial armadas. And we are thrilled to have them up here today because they have the skills and experience and insight that we need to move forward. Leading today's panel, I'd like to welcome our moderator, the Chief Executive of the Hong Kong Monetary Authority, Eddie Yu. Eddie, if you could lead this charge, please. He is going to be joined by Michael Che, who is the CFO and Senior Managing Director at Blackstone. Next up, we welcome James Gorman, the Chairman and Chief Executive of Morgan Stanley. Following him is Colm Kelleher, the Chairman of the UBS Group AG. Thank you, Colm Kelleher, for joining us on stage. We next welcome Liu Jin, the President of the Bank of China, on stage. And to complete our panel, we welcome David Solomon, the Chairman and Chief Executive of Goldman Sachs. And with that, Mr. Yu, the ship is yours to command.
Thank you very much. The theme of this first session is about navigating through uncertainties. And just now we talked about it quite a bit. The macro risk, inflation, slow growth, high interest rates, geopolitical risk, and even pandemic is still lingering around. And they're all impacting both financial institutions and your stakeholders and your clients, the corporations. And today we have a very, very heavyweight panel to talk about how they navigate or how they help their clients and stakeholders navigate through all these uncertainties. And I will just start because we can't wait to hear from them. I'll start with the corporate perspective. So James, you've been talking to CEOs around the world, whether they're big business or small enterprises. And how are your clients navigate this period of slow growth, rising inflation, much higher cost of capital? How do you see the global macro outlook? And do you see any bright spots?
Well, good morning. That's a lot to chew on first up, but let me try. I mean, firstly, context matters. What we're going through economically now has its roots in the financial crisis. That led to a decade-long period of stimulating policy, monetary policy, and effectively zero interest rates around the world. That was abnormal. Along the journey of the last decade came COVID, and obviously led to a global shutdown. Global GDP was negative 30% during the second quarter of 2020. That was obviously extremely abnormal. So we've had the two largest shocks to the economic system in the last decade that we've probably had in the last 70 years. It's not surprising that right now the markets are having trouble adjusting to that. It's not, nobody should be surprised that interest rates are going up. They're abnormally low, and reserve banks around the world are trying to get them back to some level of normality and even higher for a period because of the rise in inflation. So listen, for chief executives of large and small companies, the issues are profound. Dealing with uncertainty, however, is part of one's job description. So, to start with some of the narrow issues is just what are your COVID policies? What are your protocols about having people back working together? That of itself, and the change in the dynamic in the office space. Secondly, how do you navigate financially a period where what was much cheaper money is less cheap, and it changes your financial position as a company? How do you adjust to that? Thirdly, we're dealing with wage inflation across every part of the world. For the emerging markets, we've had wage inflation for several years. Now we've got it in the developed markets. That's another challenge to add on. And you've got broader supply chain issues and supply inflation because of some of the geopolitical issues that are going on around the world, and post-COVID, the impact on the supply chain. So, and I could keep going, Eddie. There are many issues to deal with, but this is it's a painful transition, but it's not an unexpected transition. And I think we have to keep that in context. My gut is the central banks will, in aggregate, tame inflation. I think it's highly improbable we'll get back to the kind of 1-2% inflation we enjoyed before this crisis, more like around 4% over the next few years. And we'll have to deal with that. We'll have interest rates somewhere between 4 and 5%. We'll have inflation around 4%. This is globally. And obviously, unemployment is going to tick up during this period. But listen, this is our job to manage through uncertainty. And you have to accept the market as it is and accept reality and not fight reality.
Thank you, James. I totally agree with you that the past few years probably was a bit abnormal, and we're now really just going back to normality. But that path is painful, causing volatilities in the capital markets around the world. And talking about that, I will now turn to David. Because of these volatilities, we are actually seeing the IPO market globally really dwindling, the corporate bond issuance coming down, it's not performing well. When you talk to the CEOs around the world, what do they tell you about capital flows? And does that sentiment suggest when capital markets activity will pick up, how it will look like in the near future?
Well, thank you for the question, and good morning, everybody. If you listen to what James, just walked to, James describes a period of change and a period of uncertainty. Capital markets are highly, highly geared to confidence. And we happen to be at a moment in time where there's greater uncertainty, and the trajectory of economic growth, the trajectory of interest rates are all more uncertain than they've been in quite some time. So it's not surprising in that environment that capital markets activity has really decreased. History would tell you that when you go through a transition, you go through a change, market participants, capital allocators need time to adjust to that new reality. As James highlighted, we've gone through a decade of very, very easy money, very, very accelerated asset price appreciation. And so you were generally rewarded for deploying capital and deploying capital aggressively. You're now not being rewarded for that. And therefore, investors want a much more significant discount, a much more significant risk premium if they're going to deploy capital. One of the riskier things you can do is participate in an IPO, deploy capital at a new company that's unproven, that doesn't have a track record. And so obviously those risk premiums are up very, very significantly. Generally speaking, when we've had these periods in the past, it takes somewhere between 2 and 4 quarters, sometimes maybe 6 quarters, to rebalance. I think we're going through that rebalancing period. I think there's still a significant amount of uncertainty, but as we get into 2023 and we start to have a clear understanding of the trajectory of capital markets, I think you'll see issuers and capital allocators meet again in the middle, although at different valuations and a different cost of capital than they've operated with over the course of the last decade. So I think we're in the process of that journey, and my expectations is that equilibrium will come more into balance in the coming quarters.
Thank you, David. Let me now turn to President Liu. Of course, China's economic growth, what's the macro outlook in China, and also the outlook for particular sectors, especially the real estate, is something that is of a lot of interest to our audience here. So can you give us some comments on the China macro and also the real estate sector in China?
Thank you, Eddie, for your question. And good morning, ladies and gentlemen. This is a good question. Looking into the economic future of China, I think we'd better find answers from the just concluded National Congress of CPC, because everybody knows that it has been made very clear to the world. The leadership of the party is featuring characteristics of the Chinese social system and a major driving force of the Chinese economic development. We say in the Western context, when in Rome, do as Romans do. I would like to suggest that when in China, think as the Chinese do. So in his address in the Congress, President Xi emphasizes many times the high-quality economic development, the high-level opening up, the centrality of an economy, and sustainable growth. Obviously, since the beginning of this year, China has experienced headwinds in the economy because of the COVID, on and off COVID outbreaks and the geopolitical tensions. But with the government's sustained efforts, with the continuing optimized solutions and COVID strategies, with the moderate inflation and macro economy monetary support, together with the additional efforts from the financial institutions, we see a rebound of economy in the third quarter with 3.9%. That is a good signal in the Chinese economy. So that's why I would like to rely on the fact that in the future, China, the country, will stick to the centrality of economy, and we see a bright future of the economic development. So our theme of the discussion today is navigating through uncertainties. The storm today is one of them. And I would like to suggest that the best way out of all the uncertainties is to find out and focus on what is still remaining true and certain amid all those uncertainties. For example, it is certain that the economic cycle of expansion and contraction will always dominate the global economy. It is certain that Hong Kong, as a financial center, worldwide financial center, and the important hub of mainland China and the rest of the world, will always remain, with the hard effort and grand plans made by the Hong Kong SAR government, especially in the recent policy address by John Lee, the chief executive. It is also certain that Bank of China, with a history of 110 years, here in Hong Kong 105, will work together with all the international financial institutions to support the economic growth, to support the international financial cooperation, to support the international trade. So all these certainties, just now in the address of John Lee, the chief executive, he listed a couple of hard times Hong Kong experienced in the past decades. But as I remember, ahead of and in each of the hard times, some people just left and came back. A lot more stayed in Hong Kong. And finally, they welcomed the new era, the new development together. That's the certainty of Hong Kong. That's the certainty of the Chinese economy. So once we understand well and grasp all the certainties, we can always find new ways to cope with the uncertainties. Thank you.
Thank you. So don't bet against China and Hong Kong, right? So let's turn to the investor perspective. Let me come to Colin. With all these uncertainties in markets and the macroeconomy, when you talk to your institutional investors, clients, and also the wealth management clients, how is that affecting the investment preferences and also the risk appetite? And in dealing with high inflation, rising interest rates, have they made any changes to their asset allocation strategies? Or whether, even in this kind of investment environment, do you see them go into certain areas, whether in traditional or in alternative investments, that might offer them good returns? Colin.
First of all, I don't have to agree with James anymore, but I will agree with James in that his summary of the great unwind is very accurate, and that's exactly where we are these days. We have record levels of cash in our global wealth management accounts, and in our US wealth management, as James would agree, we've got very high levels of cash too. So clients are clearly on the sidelines. You've had, over the last 9 months, pretty dire returns in both equities and fixed income and commodities, except for selective spots. I don't think, however, we've had a capitulation trade. What we've had is people waiting to reallocate and get some certainty about direction. And I think James is right. There is a feeling that the central banks will get this under control, and then there will be bright spots for investing. We're not seeing it yet. However, we have seen earning multiples in the US beginning to be revised. Valuations are beginning to attract money in certain areas, consumers, healthcare, for instance. Commodities is a selective case for people to look at. If you look at UBS's investment recommendations, we're pretty much neutral or light every asset class at the moment. But on the other hand, if you look out over the next 9 months, you can see projected returns actually looking quite attractive, not surprising given the base we're at currently. I think the world, however, is 3 parts. Whilst I think we agree the US is relatively attractive on a comparative basis, I think Europe has very big issues, not least of which is a declining size of equity market, but also banking union has ground to a halt in Europe, which means that you've got wrong way risk in the banking sector, which means that it's very hard for the economy itself to grow. And China is, whilst we're all very pro-China, and like Vice Chairman Fang said, we're not reading the American press. We actually buy the story, but it is a bit waiting for zero COVID to open up in China and to see what will happen. The only other thing I would add is that there's clearly been a big investment shift in terms of the way people are investing, and that there's more of a barbell strategy now. Alternatives are clearly becoming a very big sector for people to invest, and we're beginning to see significant demand for alternatives through our network. And I'm very pleased to say that the alternative managers are being very nice to UBS about selling their products through our network as well. So,
thank you very much, Colin. And that leads very nicely into alternative, especially the private markets. We've got Michael here. Michael, how do you think about the private market performance during this period of big market volatility? Has the public market volatility trickled down into your investments? And also in the private market space, where are the opportunities that you think are the most sort of valuable or the best ones? Michael, please.
Sure, Eddie. Good morning, and thank you for having me set up by Colin, and we'll continue to be nice to you and your colleagues, Colin. I'd say first, with respect to the private market dynamics, while private markets are obviously not immune to what's going on, as you know well, they operate differently than the public markets. They don't swing up and down with the same sort of euphoria on the one hand and depression on the other. They are less volatile by design, and both on the upside and downside. And over time, through cycles, they've consistently outperformed public markets, which is why investors are so willing to trade liquidity for that outperformance long term. Against that backdrop, we bring a business model that has some structural advantages, long-term locked up capital. We have dry powder of about $182 billion today, and a long-term sort of buy and hold mindset. And for us, after sort of 4 decades of operating through dislocations, we've tended to come out stronger. I think in terms of some of the trends we're seeing in our portfolio in generally, many parts, echoing what others have said, many parts of the economy are still running pretty strongly, though there's clearly deceleration. We're seeing, the Fed's actions and other central bank actions, filtering into the real economy, but on a lag. And we're beginning to see the slowing of both inflation on the one hand and growth on the other. But the extent to which today really depends on sectors. So, at the tip of the spear, you have sectors like for sale housing and its related ecosystem, which I think have been most immediately affected by this sea change in cost of capital. The sort of discretionary digital ad spending world is seeing a meaningful slowdown. But on the other hand, in sectors, including ones where we have a lot of exposure, whether it's travel or energy, both traditional and transitional, rental housing, logistics, you're still seeing continued strength, and that's because demand is still pretty robust and there's still shortages of supply, in some cases structural shortages of supply. So, it's a mixed picture that we see. There's a clear deceleration, but, the key tension, I would say, is that we still have a pretty tight labor market, and we're seeing, wage increases in sort of the high single digits. And that combined with, continued rental housing strength, I think means you've got a couple major components of inflation that'll continue to be sticky, and that'll complicate, the Fed's calculus from here. And the result of this is uncertainty and rising caution, and I think, you'll see that reflected from our perspective, among corporates in slowing hiring, more caution around investment spend going into the new year and so forth. To your question about, compelling opportunities to put capital work, I'd cite a few areas. First, lending money, providing private credit to borrowers. It's a highly attractive environment for that. You obviously have, floating rate debt, higher base rates, pretty attractive spreads, senior debt in the capital structure at pretty reasonable loans to value, and in our model, a buy and hold to maturity. And so this provides an excellent risk return, in this part of the cycle, always has, and it will here as well. Second, I'd say investing in hard assets with short duration income streams. In our real estate business, as large as it is, about 80% of it is in sectors that have rents growing at multiples of inflation. In our infrastructure business, that portfolio is performing really well, so that remains, I think, an area of strength in a rising rate environment. Third, within sectors like technology, life sciences, you've got, the underlying innovation continues, but excessive valuations have in many cases are now a thing of the past. So we'll see. I think that'll create opportunities over time. And then finally, just around public company situations, I would say, given the dislocation, while you might not see at this stage, public to privates from firms like us, you will see divestitures, carve-outs, what we call corporate partnerships. We announced a transaction on Monday with Emerson Electric that we're happy about. That I think is a good example of that. So I think you'll see more of that. So, I think it's simple. In an environment where access to capital in the public markets is constrained, the ability for private capital to provide capital solutions is a really important thing to the system. And for us, our business is simply an at-scale capital solutions provider across multiple asset classes.
Thank you, Michael. Obviously, even in this period of volatilities, there are areas that we can explore in terms of getting reasonable risk-adjusted returns, like private credit and infrastructure, like you said. Before I turn to the floor for questions, I have one quick question for all of you. We are continuing to look at risk in the financial system in the world. We don't know where the fault line is. We don't know where the next black swan is. So for you, what's the one biggest risk that you might see that might keep you awake at night? I know you all sleep very well at night, but if there's one big risk that you will name for us that we should watch out for, what is it? So shall we start with James first again?
Sure. I think it's inflation. We haven't had this level of inflation in 40 years. I believe the Federal Reserve and other monetary authorities kept rates too low for too long with too much QE. It's an art, not a science, in juggling where rates are supposed to be relative to unemployment, relative to GDP growth. And the probability of us hitting exactly and nailing inflation without bringing unemployment up too much but keeping GDP growth, it's hard, right? So I think my gut is we're getting there, and some of the early signs on demand-side inflation are suggestive of that. On supply side, less so. You can't really control gas prices out of, what the impact of gas out of Russia is for the global economy. But it's inflation. If we nail that, this is going to be fine.
Thank you, James. David?
I'm going to echo a little bit about what James said. Obviously, if central banks find a way to tame inflation, that, meaningfully, they do it in a balanced way, it meaningfully increases the chance of a soft landing. But we spend a lot of time looking at the fact that we're materially changing the market structure that we've lived in for a very, very long time. We've had relatively accommodative monetary policy for over a decade, almost free money. But generally, the trend over the last 40 years has really been for increasingly accommodative monetary policy. And therefore, very, very strong asset price returns. Central banks have supported fixed income markets in an enormously aggressive way. You've had a significant amount of quantitative easing. We're now in a period of quantitative tightening. And all of this, combined with inflation and a very quick tightening of monetary conditions, makes the world more volatile, more uncertain, and it also allows exposures where there's leverage in the system to be amplified very quickly. Right. We saw that in the UK. I think that's a good window into the kinds of things that can go wrong if there are liquidity squeezes or liquidity traps in markets as we tighten conditions. And so I think you've got to watch that all very, very carefully.
Thank you, David. President Liu, what's your thought about the risk on the horizon?
First of all, I'd like to say I slept pretty well in Hong Kong in the past 2 days. And if I had one or two concerns of risks, the spread of geopolitical tension would be one. Anyway, under the geopolitical tensions, any of our economic activities will be heavily affected. By the way, we talked much about the risks in the property market in China today. Let me share with you some of my observations and understandings about it. Last year, since the second half of last year, we did have some problems in the property market. There have been some developers tangling with liquidity problems, construction suspension risks, and even bank loans defaults. But finally, with the government's support, government enhanced oversight of property sales, and the government help in the address of the property-related, developer-related risks. The market is coming back. What we are saying and what is actually expected of by the government is warming up, coming back, better property market. We are pretty confident about it. And I'm sure that nobody than the Chinese government, than the Chinese banks, cares more about the property market because it has too much to do with the manufacturing industries. And then the GDP growth with the financial stability. So don't worry too much. As Mr. Fang said, don't read too much negative reports.
Colin?
What keeps me up at night is the question. It reminds me of a story about Marlon Brando at the Lee Strasberg acting studio. And he was told by Lee Strasberg, "You're a chicken, there's going to be a nuclear attack." So all these other actors were running around panicking, and Brando just sat there clucking. And Strasberg said to him, "What are you doing?" He said, "I'm a chicken. What do I know about nuclear attacks?" The point I'm making is I can only worry about what I can control. And the only thing I can control with Ralph is the health of our bank. So everything else kind of lets me sleep at night. I can't control inflation. I can worry about it. I can't control the global thermonuclear war. So in many ways, I sleep pretty well. Thank you.
Thank you, Colin. Michael, anything?
I'd simply say what keeps me up is the possibility of rising tensions around the world that could lead to serious threats to stability.
geopolitics as well. So let me open the floor for questions. Before you ask the question, please say your name and also your institution. Yes, one over there.
Thank you. I'm Henny Sender. This was a wonderful discussion. What I wanted to ask you about is where we all went wrong before COVID, when we all thought that technology would be profoundly deflationary, that as the sharing economy meant that, say, cars would go from being a thing to being a service. We thought the issue would be excess labor rather than a labor shortage. To what extent do you think that COVID has just totally made for a secular change, or is it only temporary before we see these deflationary forces coming back into?
Why the sudden swing? Maybe James, you talked about inflation earlier. Any thoughts on that question?
Well, Henny, I think the period we went through with COVID, and we're obviously still going through here, and the constraints and controls and the impact it has on the economy it was life-changing. The last time we had a global pandemic, I think, was 1919 with the Spanish flu of this magnitude. Obviously SARS, MERS, but a global synchronized pandemic that caused GDP growth to be negative 33%. So that's the kind of shock that for all the technology changes that have taken place, it clearly was going to disrupt that. But now we're getting back to normalization. I think you're seeing unemployment starting to tick up globally. You're seeing some increase in worker participation, people who sort of the so-called great retirement, as people survived on various government payments, realize those payments have now stopped. You've actually got to go back to work if you're going to pay for your mortgage. We're seeing, so as a result, we're seeing more competitiveness in the labor market, and I think wage inflation will come down. And the digitalization of the economy and the technology changes are not for nothing. There was a lot of hype going into it. There were companies trading at 50 times revenues, which is just insanity. So that's been flushed out, but that doesn't mean the whole digitalization of the economy got flushed out. So I saw it as, you know, clearly the kind of unknown that not even Donald Rumsfeld might have conjured up COVID, and here we are now, and I think we'll get back on track. Subject, of course, to geopolitical and other things outside of the direct economic factor.
Anything to add from other panelists on this point? If not, then I'll turn back to the floor. Yes, Raymond? The mic's coming.
Thank you. Raymond Chow, PwC. And thank you for that conversation this morning. That was wonderful. My question to the panel is actually, we talked a lot about the uncertainties and the risk, which I agree 100%. The one thing that I want to ask the panel and your view on is we didn't talk about ESG. One of the major issues facing the world in the medium and the longer term is obviously ESG issues, and specifically climate issues. And given the many risks that we just talked about, how your view in terms of the financial market, and are we slipping in terms of our focus of building sustainable finance and sustainable growth in the longer term because of these short-term risks that we're focused on, whether it's inflation, whether it's recession, et cetera, that we might have lost a bit of focus of working together to build a sustainable future.
Thank you, especially when we see energy prices going all the way up. Are we losing track on ESG? Maybe Colin?
I certainly don't think we are. There are short-term challenges. However, we know what ESG is. What we're waiting for as financial intermediaries is codification the rigor and the regulations that go around it so we know what we're reporting, right? So in many ways, it's very loosely defined at the moment, as you know, right? And there's no real accountability as yet. Saying you're going to be a leader in ESG is one thing. Saying you're going to be top 3 in ESG, what does that mean? So we're waiting to see what various regulators, commissions, we know the gestures of intent from the UN, from the EU, and from others. We're waiting to get actually hard codification of this to come through from people like the SEC, the CFTC, and other regulatory bodies. Our investors clearly are focused on this. So this is not going away. This is thematic. And in many ways, the sooner we get clarification, the better for all of us. And, you know, we already have generated a huge amount of ESG funds, or whatever. We have to make sure, though, that investors understand that these are correctly identified. You don't fall foul of the greenwashing charges that have happened elsewhere and so on. So I think this movement is totally unstoppable, and it's what Generation X, Z, millennials, etc. want. Yep.
Thank you, Colin. James, you want to add?
I think it's, as I said at the outset, the list of things that we're worried about is long, and it was an incomplete list because we've got to focus on the immediate to sort of get through this. The ESG focus, I just came out of a board meeting. We discussed it in the Audit Committee, Nominating Governance Committee, Risk Committee, and with the full board. It is part and parcel of what every company is doing. But I think more recently what we've seen directly is the impact on German industry and particularly European energy prices as a result of the war, the Russian war in the Ukraine. I think that ironically set back the ESG debate one step and propelled it 2 steps. The step back was obviously, well, you can't have the economy collapse. You need to find energy, whether it's brown energy or clean energy, you need energy. The 2 steps forward is you better figure out a way to create energy supply which you can control and is not dependent upon somebody else cutting off pipes or pipelines. And I think, you know, look at the difference between the way the French position now versus Germany in the relative energy positions of those 2 countries, nuclear versus gas. So if anything, I think it's become, it's accelerated the discussion of ESG the recent period. But it's not something as CEOs that we can do something about today relative to making sure your organizations survive this period of transition that we're in. But it's always there on the table.
Thank you. I'm glad that the momentum is there. President Liu?
I agree with those comments, and we have never stopped our ESG steps during the hard COVID time. As a matter of fact, in China, in mainland China, ESG and sustainable development has become more and more popular. You know, MSCI, I'm not sure whether you are here today, and you have become more and more popular and welcomed in China because of your excellent ESG professional service. And in the past 3 years, a few of our customer managers are meeting in person with our clients. But we do a lot of sustainable development research, especially concerning the coal mining industry and iron and steel industry. You know, sustainable and green development is a big idea. We have to go into details. I asked my colleagues to go to the iron and steel factories and mining coal mining fields to identify which particular part of the factory belongs to green field, which we are going to make further loans to. So after 2 years' effort, we have achieved quite a lot than before. Thank you.
Thank you. We still have about 5 minutes, so maybe one more question from the floor. Yes, over there.
Hi, Brian Sack from D. Shaw. So it sounds like the panelists agree that even if central banks do their job and address the situation, we're going to come out on the other side of this with a higher average level of inflation, a higher level of interest rates. What I wanted to ask is, what's the degree of uncertainty and volatility in that state? Can we get to a world where volatility, we sort of settle down around this higher level and volatility actually comes back to the low levels we saw over the past 15 years? Or does the high level of inflation and interest rates automatically go hand in hand with a much more volatile environment than what we've seen in the past couple of decades? Thank you.
Any thoughts from our panelists? Maybe I should start from David.
So I appreciate the question, and it's a very good thing for all of us to think about. It's very hard for us because we've been living in a world where money's been so free, and the tailwind of free money, has had such a consistent impact on asset prices in one direction. It's very hard to go back to a period where you have higher embedded inflation, higher embedded interest rates, and the consequence of that. I think fundamentally that very, very loose monetary policy tamps down volatility because it's very one-directional with asset prices, generally over time. So just intuitively, you would think of the distribution of outcomes. The outcome is if we settle in with, to use James' scenario, 4% inflation, 4 or 5% rates, you're going to see a higher level of volatility than we saw through a lot of that period where money was very free. That's not certain, though, and there are other factors and other contributors, that can impact that. Policy will impact that. Economic activity will impact that. I think what we're wrestling with at the moment is there's just a lot of uncertainty as to what that path is. We all talk about the fact that we think we'll be able to navigate through. I know we'll be able to navigate through this, but the path of how we navigate through, how far central banks have to actually go to tame inflation, do they get to a resting point and make progress, or do they have to go meaningfully higher and then back up? All of those things are going to have an impact. And so I'd still say that the path, in my mind, is quite uncertain, and that will ultimately play on volatility over the next 12 to 24 months.
A bumpy road. James, anything to add?
Well, I would not underestimate the importance of a healthy banking system. I'm going to sound like I'm talking the book of the people on the podium, and I am. The capital requirements for the banks and enabling the banks to have the balance sheet flexibility to intermediate markets, which is what they're supposed to do, is essential to managing this volatility. So the wrong answer would be in a period of rising interest rates, what will be high volatility with explosions sort of in different parts of the economy, for the banks not be able to play the role that they're supposed to play in intermediating and providing liquidity for the markets. And I think that's it's a policy issue of safety and soundness of the banking system, and you want the banks safe, obviously, and the banks are very well capitalized thanks to the last 12 years of regulatory reform. But you need to ensure that they're sufficiently sound that they can do the job they're paid to do, which is to drive economic growth through providing a balance sheet both as liquidity and for a lending product in the market.
Thank you, James. I'll certainly bring that message clear and loud to my regulatory friends in Basel. So with that, I will close the session. It's been a very great and rich discussion, which I don't attempt to summarize, but I hope that you've all been benefited from the insights and thoughts of our very bright minds on stage here. So I will invite you to give me a round of applause to our panelists. Thank you very much.
And thank you, Mr. Yu. Thank you to our panelists. Gentlemen, if we could get you to gather at the center stage to take a photo to commemorate the occasion, that would be ideal. All right, ladies and gentlemen, we are back in action here at the summit hosted by the Hong Kong Monetary Authority. I'm going to ask all the good Canadians to take their seats. Hope you like the socks, Mr. Carney. You see that? You like that little Hudson Bay? Fantastic. And so you know that we are back, ladies and gentlemen. The doors are closed. The typhoon is outside. The brain power is inside this room. And we have a panel ready to go on side stage, ready for you. So this panel is going to be discussing sustainable finance. Now, whether it is environmental, social goals, or governance, ESG is very much in vogue these days. But our panel is going to be discussing how, and if it is possible, to make good on the promise of directing capital to virtue and profits. Fortunately, we have a spectacular moderator for this today. He was the former CEO Asia Pacific for JP Morgan before being elevated to their global head of private banking. Until all that happened, until early last year, he was appointed the Chief Executive Officer of the Hong Kong Exchanges and Clearings. Ladies and gentlemen, please welcome to moderate your panel, Mr. Nicholas Aguzin. Gucho, bienvenidos. We welcome to the panel Mr. Joseph Bay, the Co-Chief Executive of KKR. We welcome Jin Lee Kun, who is the President and the Chairman of the Board of Directors for the Asia Investment Infrastructure Bank. Thank you. We also welcome Anand Selva, who is the CEO of Private Banking and Wealth Management at Citigroup. And completing our panel, we welcome Hanneke Smits, who is the CEO for BNY Mellon Investment Management. Thank you very much. Gucho, the floor is yours. Take it away.
Thank you very much, and welcome everyone. Good morning. Great to see again so many faces in real person. It's a great event. Thank you, Eddie, for organizing, and all the HKMA team. We have a great panel with a diversity of backgrounds, people from the private sector, public sector, representing Asia, representing global, a lot of areas for a very important topic, and it's especially important for Hong Kong, being in the middle between China and the rest of the world, and in particular, a topic that is very dear to our heart at HKEX, because just last week we launched our climate exchange, which is a great initiative. We call it Core Climate, and it's going to be a great tool for making sure that we help in the transition. Now, today we're going to be talking about trends and how each of the different institutions here are tackling this sustainability challenge. And we're going to get right into it, and I'm going to start with Hanneke. Hanneke, I have a question for you around, is it possible to do good and to do well at the same time? And how should we be looking at the trade-off between social and private benefit? And let me add just one more point to this one. A lot of investors have been penalizing certain industries. In particular, oil and gas is one that's been discussed quite a bit. And there are many other industries, and we can think about agriculture and also electricity generation, whereby there are a lot of social benefits of really having those industries functioning, but they haven't been to the same level of scrutiny. So how are you looking at that, and how's your company looking at managing those balances?
Okay, thank you, Nicholas, and good morning. It's always a challenge to start with a two-part question of such great complexity. I also want to say thank you to the HKMA for hosting this. I actually started my career in Hong Kong in the late 80s and very much enjoy coming back and feeling its energy and connectivity to the mainland. I also thought it was very fitting, given the topic of this panel, that the last panel had a question on ESG and whether it's off the agenda. And I can assure you, as you can see on this panel, it is very much on the agenda and very much on the mind of investors, companies, governments, and alike. To the point, Nicholas, of whether you can do well by doing good, we very much believe you can. Responsible investment is really no longer a nice to have and is really increasingly embedded in all the investment decisions that we all face as investors and as shareholders. It's a very fast growing area of the market. I think you've all seen the numbers, and to some extent this is very much a shift in society from focusing on shareholder primacy to stakeholder responsibility. And ESG risks can really, speaking as an investor, can really no longer be overlooked when we value companies. They appropriately highlight the risks as well as opportunities and provide signals that drive valuation processes and can really materially impact intrinsic value. So I think it is actually absolutely possible to do well, to do financially well for investors by doing good at the same time, by focusing on companies that deliver sustainable business models. Now, to answer your question of how do we invest and where do we invest? Well, first of all, to address ESG, the world needs a lot of investment. We recently published a report that is showing that the world might need something along the lines of about $100 trillion to get to the goals of net zero by 2050. That's a lot of money, but in the context over a long period, we actually think it's achievable. Now, in order to do so, we must not shun the polluting sectors, and in particular, the sectors that need the investment the most are energy, utilities, and airlines. We believe it's very much going to be a combination of accounting for the value of stranded assets, which we estimate is going to be in the order of about $20 trillion. But we also, as an investor community, I think have a responsibility and duty to consider allocating capital to invest in those companies that need to align to net zero. So I think there's opportunities to invest. I think we must do it through engagement with companies and support them in their capital reallocations towards a greener world.
Thank you, Hanneke. And Joe, let me turn to you and to the private equity industry. And the PE industry obviously has been laser focused on returns, and KKR has been doing a lot in terms of sustainability. Particularly, you've launched a dedicated impact investing fund. And then in addition to that, you've been very focused in promoting transparent reporting practices such as TCFD, aligned climate disclosures. So would love to understand a little more what's driving your decisions, how you're thinking about this, and the role that you play in the sustainability agenda.
Great. Well, thank you, Gucho. Let me first start by saying thank you to Eddie, your colleagues at HKMA, for having us here today. As also a former Hong Konger, I lived here for 10 years. It is really terrific to be back, to see the energy come back to the city, to see our colleagues, our friends, family, et cetera. So thank you for having us today. You know, this topic around sustainability and responsible investing, I don't think is at odds in any way with making great returns. I actually think it's foundational going forward to making great returns. Our job as private investors and also on the public side is to invest in companies and make them stronger, to build better businesses, more resilient businesses, to minimize the risk while you're owning these companies, and create something that's ultimately more valuable 5 years, 10 years down the road when you either take the company public or sell the business. And you can't do that in today's world unless you have a real focus and competency around ESG, around sustainability, and a focus on being really responsible owners of assets in the world. So for us, this journey is not a new phenomenon. We've been working on this for the past 15 years, really, in terms of trying to institutionalize these capabilities and practices. We partnered with the Environmental Defense Fund back in 2008, actually, to create a green portfolio program for KKR portfolio companies. We started publishing an annual sustainability report back in 2008, which we publish every year. In 2011, we started focusing on more the S of the ESG, which is broad-based ownership in the companies that we invest in, where we push stock ownership down to every single employee in these companies. That employee engagement is critical in a world like today where labor is in short supply, where people are worried about retention. That's proven to be an incredibly powerful tool to improve productivity, to align the workforce with management, and ultimately with shareholders to create more value. And what's exciting about today's world is when you have a focus on sustainability, there are incredible opportunities to invest today. This brown to green transition, which was just referenced, is going to create tremendous value. The opportunities for our impact fund, which are aligned with the United Nations SDG targets, our infrastructure business globally, that's investing in renewables. It's just an incredible time, actually, to have this focus for both great financial returns and to do the right thing.
Thank you, Joe. That's great. Anand, next question is for you, and tackling the E and the S in ESG. How do you think these two work together in terms of advancing the global sustainability goals, and what's your firm doing in terms of promoting sustainability?
Good morning, everybody, and thanks to HKMA for having us here. It's wonderful to be back in Hong Kong after 2-3 years, so good to be here. So the E and S absolutely go hand in hand, and our financing commitments at Citi are aligned with that approach. We look at it together. So we have a $1 trillion goal for, towards a $1 trillion goal in 2020 and 2021. We have financed and facilitated around $220 billion. It's a spectrum of activities. So if you look at the environmental activities will include clean technology, renewable energy, water conservation, sustainable transportation. And if you look at the social activities, it's around education, it's around healthcare, it's around affordable housing, food security. So it's been a wide spectrum of activities. And when I look at in Asia here, Asia is a great example. We've had several firsts in Asia around green bonds, as well as in sustainability offerings with companies like LG Chem, BPI, Woolworths, to name a few. We also, last year, for our Asia clients, we raised over $40 billion in global and local capital markets to support their sustainability financing needs. So we've been working with our clients and helping them out. And in Hong Kong itself, we have one of the examples here will be our building, City Tower building. It is the largest on-site renewable energy system that we have. So we have been working with clients to helping their needs and helping them transition to net zero. At the same time, we've also been driving actions ourselves for the better of the environment and for long-term benefit of the communities. So a lot of activities, and it's a spectrum of activities, Nicholas.
Thank you very much, Anand. Jin, going back to AIIB, as a multilateral development bank, you play a key role in trying to bridge the gap between return expectations and also bearing some of the risks to help in this objective. So what are the tools that AIIB has to be able to deploy for this purpose? Have they been effective? And then also, I know you have a big war chest to do this, but the task ahead is really big, and there's a lot of capital needed in this transition. So what other parties can you enroll or enlist to try to help in this sustainability fund?
Thank you very much. It's very nice to be back in Hong Kong after an absence in international forums for a good 3 years. And it's so nice to see you in person. And I would like to say just a few words about Asian Infrastructure Investment Bank as a multilateral development bank. Probably people don't know very much about what it is all about. You know about the World Bank, ADB, EBRD. Our bank was created in the 21st century with the developing countries as majority shareholders. So this is a little bit different, even though we are patterned on the Bretton Woods institutions. But this is the first multilateral development bank with developing member countries as the majority, with our shareholders from all the continents except Antarctic. Now, this is a very important feature. You may ask me, if the developing countries are the majority shareholders, what is the incentive for European countries, developed countries to join. Because you made the rules, you play all the rules. Is there any rule for us to play? The answer is yes. We have very good check and balance. And European countries and also Canada, they have more than 25% of the votes. The major policies approved or the election of the president must have 2/3 of the members and more than 3/4 of the voting power. Which means even though China is the major shareholder, China will not simply call the shots. So this is the very good teamwork spirit. And just because of this nature, the bank focuses very much on development by very high standards. And we talk about ESG, we talk about green financing, sustainable development. And all this is deeply embedded, all these principles are deeply embedded in our Articles of Agreement. So you talked about a war chest. Actually, it's quite negligible compared to the major financial institutions represented here. We work with BlackRock, JP Morgan, Morgan Stanley, HSBC, and all these institutions. I think our resources are very much limited. So what we do is try to leverage our resources to mobilize the private sector money for sustainable development. I think what is different today, we should never ever count on the public money for development. And I don't think it's right for development banks to knock on the door of the major shareholders asking for general capital increase every couple of years. That's not sustainable. So we focus very much on the cost effectiveness. And we look at the very essence of how to develop the infrastructure projects. We call it infrastructure for tomorrow. What does that mean? It's not infrastructure projects which are designed and implemented in a very traditional way. We incorporate climate change mitigation adaptation, and we have the framework to monitor the effects. For instance, all of the MDBs work out a climate change mitigation adaptation tracking methodology. So you look at our performance by all these public standards. Let me stop here.
Yeah. Thank you. And I'd just like to follow up on something you mentioned, which is the $1 trillion commitment that Citi made in terms of sustainable financing by 2030, I believe, correct? And I mean, clearly you have a very international operation. And I mean, how do you square trying to maintain consistency and a uniform standard with the practicality of having local operations and very local characteristic in each of the markets where you operate? Do you try to apply a consistent standard across the world, or do you take into account differences in each of the local markets where you operate?
Thank you, Nicholas. Great question. Similar to how we run our global businesses, we don't take a one-size-fits-all approach. We play to our strength, our global network, our global capabilities, and also our local expertise. So we have on-the-ground presence. So our on-the-ground presence, our relationships on the ground, our local capabilities are very important because that positions us uniquely to help our clients' individual needs. At the same time, we are very mindful that countries are at different stages of development, right? And social and energy needs vary by country. And sustainable development efforts are inherently local. I mean, issues like energy and food systems are pretty much hyper-local. So we lean into our local expertise to understand the local markets, the demographics, the local social and environmental challenges, and then combine with our global capabilities. So while towards our $1 trillion goal, we have global policies, global programs, but we marry them with our local on-the-ground presence. Now, as we build all of this, as we continue to all of us work together to reduce emissions, I think there are a few things we need to do. One is we need to find mechanisms where from a funding perspective, as we fund decarbonization, the funding needs to be efficient and equitable. Today, most of the funding goes to investment-grade markets. The emerging markets are not getting the funding. And you cannot expect the emerging markets to be spending on decarbonization at the cost of their economic growth, because they have their own set of social challenges that they need to deal with. So it's our responsibility to help scale the funding, getting the funding for the developing economies, as well as looking at opportunities to fund new industries that support sustainable development. Now, all of this is doable. As we do all of this, I think one of the things that we need to work on is data. So we know that availability and the quality of ESG data has been an industry issue. Regulations are localized. You have disclosure requirements that vary. That leads to fragmentation of data, which leads to data complexity. So that's something we all have to collectively sort of solve for. And I guess there's an opportunity in Hong Kong for Hong Kong to take the lead, and being the leader in ESG in the region, and continue to lead in developing international standards, establishing regional sort of best practices and disclosures. Then you can sort of, we have to overcome the data complexities that we have and the fragmentation, and there's a great opportunity for Hong Kong to do that, and also build out a carbon market here. So that's how we approach Nicholas. So it is not a one-size-fits-all. You got a bit global and local altogether.
Okay, thank you. Jin, you're headquartered in Beijing. You invest across all of Asia. And by the nature of your institution and the projects that you invest, I mean, you're subject to a lot of scrutiny. In a world where, especially around sustainability, where we don't have standardization and there's increasing risks of like greenwashing, how do you manage those risks and that lack of standardization? And in particular, last year, you launched the Sustainable Development Bond Framework. So can you tell us a little bit more about that as well?
Well, thank you very much. The challenge of a multilateral development bank, particularly with China as the biggest shareholder, is formidable. And I know quite a lot of people put this bank under the microscope. If there's any defect, they are going to magnify it exponentially. So we are very careful. And reputation is very important. From the day one, we made it very much clear that this bank would go by international best practice. We would have very solid environmental social framework to follow. But we know reputation is something, or trust is something you have to earn. You cannot talk people into believing you. 7 years into operation, we grew from 57 founding members to 105. Why do these countries join us along the way? Because they believe we do what we declare. Okay, we mean what we say. So when it comes to the operations, for instance, everybody now is focused very much on climate change. As I said just now, climate change, mitigation, adaptation is very much important. And you cannot tell the people, we are doing wonderful things. By what kind of standards? That's why World Bank, ADB, this bank, they all work together to produce the climate change, mitigation, adaptation tracking methodology. Likewise, ESG, environmental social framework, we have to process each and every project to make sure they will not violate international standards with regard to, for instance, environment. We are to improve environment, not to destroy environment. So everybody is watching us, and powerful CSOs, NGOs are following very closely everything we do. Now, talking about greenwashing, how can we make sure it's not greenwashing? For instance, we have this framework, Sustainable Development Framework, would give you clear indicators. And we issue bonds, for instance. We can issue green bonds. And green bonds would be earmarked for instance, climate change mitigation projects. But our framework covers more. We work with the financial investors, institutional investors, making sure that this is a holistic approach to deal with the climate issues. So I think it's better than simply issue green bonds, which means everything we do, all the financial resources raised from the market would be for climate change mitigation. So I think there are lots of things I have no time to elaborate, but by actual work on the ground, we can enhance people's confidence in this institution. I know it's very easy to lose confidence. When you lose confidence, they will never come back. Thank you very much.
Thank you. Hanneke, some people in the sustainable investment community point out that Asia is actually behind the other regions in terms of promoting sustainable investment practices. So can you tell us a little bit about your observation in terms of where client appetite, readiness between clients in Asia and the rest of the world is?
So sitting here in Asia, I would say the region is catching up relatively fast. It is behind certainly Europe for sure, and to some extent the US, but we're seeing both from an investment required perspective as well as what we're seeing from our clients. We're seeing an increased desire and need for sustainable investment objectives to be integrated in the portfolios. And we also have started to see a framework being developed by the various regulators around the region. As previous speakers on this panel and the other panel have mentioned, clarity around data disclosures is really, really important in this context. So I think also this is to some extent, this catching up is also happening because this region is feeling very keenly the effect of climate change. I mean, we're sitting here, thank goodness the typhoon is sort of reduced, but the floods everywhere, increase in typhoons is bringing many of these issues to the fore, including of our investors and our clients. And having said that, sitting in emerging markets and in this part of the region, it actually needs about half of the investment that I mentioned earlier of this 100 trillion that is needed to get the world to net zero by 2050. And that is because the economies here are projected to grow faster, they're energy dependent, and so therefore it needs even more capital than we see in the developed markets needs to actually get to that greener future. I also think there's a great opportunity here from an investment perspective to leapfrog some of the carbon-intensive technology that we see is very much embedded in developed markets. And an analogy that comes to mind was how mobile phones leapfrogged the needs in Africa to actually lay down landlines which weren't in existence and saw an explosion in growth. And I think in the same way here, there's an opportunity to make some very interesting investments that are less carbon intensive and providing good opportunities in a sustainable chain. But with that, we must make sure we get better data and better disclosures, because in the short term, what we're seeing is there's a little bit of the knee-jerk reaction and risk that investors in the region divest rather than invest in the sectors that actually need it most.
Okay, thank you. Joe, you mentioned you lived for many years in Hong Kong. You know Asia very well. So how do you see the Asian landscape, and what are the challenges and opportunities in terms of sustainable investing? And you agree with Hanneke that Asia is catching up very quickly?
Yes, I definitely agree with that sentiment. You know, I think the context matters again. When you think about climate and carbon, the three biggest carbon emitters in the world are China, the United States, and India. For the world to really make progress around carbon and decarbonization, you need Asia to be a leading force in that, given the presence of China and India. The growing energy consumption, given the demographics, given the young populations, this is going to be both an enormous challenge for Asia, but also a tremendous opportunity for investment. And I think I'm more optimistic that regulators, governments, private sector will find a way to harmonize the data piece of this over time, the measurement of every company and reporting. I think that's something that will get done in a reasonably short period of time. I think the really hard work, though, is how do you actually not only measure, but what are the strategies to actually materially decarbonize and improve? That work is really, really difficult. As shareholders, as owners of businesses, I think that's where the focus needs to shift, is less about just getting the reporting right, which is foundational. We need to do that. But then it has to shift to what does it mean to be a responsible owner of a business? What are the right targets to be setting for management? And that's an infinitely harder, problem to crack.
Okay, thank you very much. And I'll have now a last question for all the panelists. Hanneke, maybe I'll start with you. Around the approach that we're taking to climate change today. Do we all believe that this is adequate, not just quantitatively also, but from a quality point of view? And should we look for other ways to tackle the problem?
So thinking a little bit through sort of the theme of this, of today, how we navigate uncertainty, I just want to first say the one thing is certain is that we must address the challenges that are upon us with respect to climate change. And combating climate change is clearly an enormous task, but it is still something that we believe is not insurmountable if we ensure that finance is being directed to the areas which most urgently need it. Now, the investor community cannot do it on its own, right? We're going to have to collaborate with government and policymakers to ensure that the right incentives and frameworks are put in place so that we can together achieve the goals that are needed by 2050.
Okay, thank you. And Anand?
Yeah, I'm clearly sustainable finance is the future. There are obviously the things that we talked about is the interim that we need to work through. And financial institutions have a role to play in helping clients to transition to net zero. There are 2-3 things for me as comes up. One is obviously data. We talked a lot about data, so that's something that we all need to work on. And I think one of the things that I've found very encouraging listening to my Hong Kong colleagues here is that in Hong Kong, HKMA's Green and Sustainable Finance Center is working on developing talent and data. I think that is good. We need more of that. That is one. Secondly, obviously, I'm saying the obvious, we need enabling public policy and regulations. Because what we need is clarity and consistency, like we talked about in disclosures and in terms of data. So I think that's an important imperative there. The third is, Hanneke was saying, it's about partnerships. No single country or a single company is going to make this work. So it is all the stakeholders. It's a big teamwork of it's the policymakers, the regulators, it's the FIs, it's the development banks, it's the civil societies, all need to come together to sort of drive this. At Citi, we are taking a long-term view on this. This is a 30-year event, right? And it's going to have significant upfront financing cost as we are sort of transitioning to clean energy and et cetera. So that's the way we look at it. I just thought a little bit of shifting a gear a little bit for a second. I manage the wealth business. So when I speak to my wealth clients, it's very interesting. The wealth clients are more and more now focused on ESG as they're investing for themselves. And that has never happened before. So we see that happening. And we have a platform called Investing with Purpose. And our clients, we help our clients use that platform to make responsible investment decisions. And when this whole intergenerational wealth transfer is happening, which is estimated to be about $15 trillion by 2030, the next generation that's getting the wealth transfer is even more ESG conscious. So there is hope here. People, it's not only the institutions, even the individuals, as they're investing, they're looking at ESG and they're very focused on it.
Yeah. Jin.
My view is that sustainable financing ultimately depends on the quality of the investment you make. I would say gone are the days when the private sector could come to certain investment, make quick wins and leave. I think time have changed. and even private sector investors will have to comply with quite a number of very tough standards. So how could we make sure that what we invest today would give us a long-term benefit, not individually, but collectively? I would say, for instance, we invest in infrastructure, which has a long gestation period associated with risks, particularly with regulatory and macroeconomic risks. Your due diligence of a project could be very good, but you didn't know about the macroeconomic or geopolitical storms. So individually, I think it will be even more difficult for the private investors to be assured of their success. That's why we need to work together. And also, I hope the investors who work with us will not expect this bank would close the gap of risk-adjusted returns. I don't think we can do that. But there's one big advantage of working with the multilateral institutions like our bank, IFC, or EBRD, because we have maintained a dialogue with the host country governments. Even though the projects we finance are private, we don't have guarantee, but we want to make sure that macroeconomic and regulatory policies are in good place. If there's any change, they should be changed for the better. So I think we work together to create a very good environment for sustainable investment. The projects you finance are sustainable, and your financing will be sustainable. Thank you.
Thank you, Jane. Joe, your thoughts?
Well, listen, I do think there's a lot of progress being made. I think it's important to recognize, though, that whether it's companies, there are no two companies that are the same. They have different issues, different challenges, and one size does not fit all when we're talking about climate or ESG. And the same goes with the access to capital in markets like Asia. Right? We have obviously has China and India as two enormous economies where capital access is very different than, say, Southeast Asia. Smaller economies, less developed capital markets. So I do think there needs to be this recognition that where private capital certainly could add value is in some of those gaps. One of our largest investments through our infrastructure fund is in the Philippines, in First Gen. They produce almost 20% of all the electricity in the Philippines, and it's almost all renewable. It's geothermal, hydro, wind, and solar. But the Philippines is not a market that gets a lot of capital flows from international capital. Certainly from development banks and local banks, they'll get some capital, but there are real gaps in terms of just availability of funding. And I think that has to be a big part of the solution in this region.
Well, thank you very much to all my speakers. We're getting to the end of the time. We may have time for one question from the audience. So any questions for our panelists? Yes.
Thank you very much, Nicholas, and thank you very much to all members of the council, of the panel. My name is Tony Neo, and I sit on the board of ICBC and CITIC, and we completely agree with you that ESG is an organic part of the business environment, and it is there to create value for our shareholders. But I'd like to just drill down a little bit on the specifics. We have been seeing, in fact, in the past maybe 10 years, an increase in public and private participation, which is known as PPP, for the investment of infrastructure and so on. We see securitized projects, a securitized product coming out of these. The UN is very much involved in setting standards for PPP. I'm involved in one of those working parties, and I'd be very interested to know your views on how PPP could be effective in financing development, how in your portfolios you see PPP as being an effective method for creating value. Thank you.
Thank you. As a result of time limitations, maybe, Jin, you can take that one.
Tony, thank you very much. Nice to see you. It's a long time. I think this is a very important topic. So far, I would say PPP projects outcome seems to be mixed. And you cannot put down to any single root course if there's any problems with the PPP projects. It calls for the public sector and the private sector work together. But there are also some very good projects in terms of PPP. I think, first of all, the government should provide facilities, but the government should not behave like a mother-in-law. You know, this is very much important. And the private sector should also know how to behave. I'll give you one example. Some very successful PPP projects in China. It's healthcare, old age care. The government provide low-cost land, and private sector build the healthcare or old age nursing homes and this kind of thing. And they work it out very well, because taking care of the older people is a challenge for China. I think it will be increasingly difficult, but you cannot depend on the public money to take care of so many Chinese old people over 60 or 70. I'm young. I'm 36 years old, only the second round. So I don't need this kind of thing, help so far. But I do know there are lots of people who need it. So the projects I refer to, government provide low-cost land or some other facilities, private sector put money, and they work together on the market basis. I think that's the best approach. Thank you very much.
And thank you very much to all my panelists and to everyone. The conclusions of this is that this is an evolving space, a lot more to do, and we look forward to continuing the dialogue. Thank you very much.
Muchas gracias, Senor Aguzan. Thank you. If we could prevail upon our panelists to head to the center of the stage for a photo, that would be wonderful. Thank you. Thank you once again to our panel. I would like to remind everybody that there's a lot happening in Hong Kong this week. This is also Hong Kong FinTech Week is happening right now, and there's a bevy of events happening in the lead-up to the triumphant return of the Hong Kong Rugby Sevens. So I hope that you're going to be sticking around for the rest of the week and beyond to enjoy Hong Kong. Now, our next panel is going to be looking much farther than 1 week into the future. Whether it is artificial intelligence, crypto, DeFi, big data, my thing, central bank digital currencies, there are a host of new technologies on the horizon that are impacting now, and they are changing how we think about finance, how we think about banking, even how we think about the fundamental nature of money and society's relationship to money. Fortunately, we have a fantastic leader for this panel to look at technology, innovation, and the future of finance. He is Neil Shen, the founding and managing partner of Sequoia China. He has topped Forbes' Midas list on multiple occasions and is now ready to lead our panel today. Neil Shen, please. Joining him on today's panel is Rob Capito, the president of BlackRock. Also taking the stage is Daniel Pinto. Daniel Pinto is the president and chief operating officer of JP Morgan Chase. We welcome today Noel Quinn, the group chief executive for HSBC. And appropriate sitting next to him, as their buildings do in Hong Kong, the group chief executive for Standard Chartered is Bill Winters. And with that, Mr. Shen, take us to the future.
Thank you. Well, first of all, I'd like to thank Eddie and his team for hosting this wonderful event. And I'm so honored to be here and moderate this panel, which will talk about the technology, innovation, and the future of finance. So I think technology is really reshaping the future of finance, and probably no other innovation have come to epitomize the potential of the tech in finance as blockchain technology. While we have seen some interesting transactions, most of those are still very small, and DeFi uses are still not mainstream. The bright spot is that 2 days ago, the Financial Service and Treasury, the Treasury Bureau in Hong Kong has issued a policy statement on development of the virtual asset in Hong Kong. And thanks to Paul and his team, and I think this is clearly very, very enthusiastically accepted by the market. I think we have 3 pilot projects. One of them actually relate to us. There is an NFT issuance for FinTech Week. I don't know if any of you has download that and get that. I was told that you need to go to the physical counter to get that. But it's a very interesting trial, I think. And then we're talking about the tokenization of the green bond, and obviously, very importantly, the e-Hong Kong dollar. So the first topic I think we should ask in this panel is about blockchain. And the first question goes to Daniel. I mean, JP Morgan has been trying the blockchain application with payment. Can you share some thoughts on that, and what could be done, and what further could be done with that technology?
Thank you. Thank you, Eddie, for the invitation. It's great to be here after 3 years. So we started this journey a long, long time ago. So when Bitcoin and other cryptocurrencies started being a bit more popular, inside the company, you have all kinds of views. People that were positive, people that were negative, but we were all fully aligned was about the power of the technology underneath. And also we realized that in the form that it was used, it wasn't exactly the type of technology that we need to be helpful for our clients and for us to process a lot of transactions per second and all that. So we developed first a platform called Quorum, which is our distributed ledger platform. We made it open to everyone, an open source. Every company could use it. And that was the base. And from there, we started thinking and developing products or services that would be run on that platform. The first one was Links, which is essentially a network of banks. So 400 of them, they are signed up. Close to 100, they're already operational there. And essentially, it's a way to exchange data for validation of payments. That is something that exists. In the US, still people write a lot of checks, and they go in boxes around the country. We have created a product to digitalize and stop that. And in the future, as more and more banks come into the platform, we will see services related to fraud, services related to foreign exchange services, so other things. It's an open platform. The banks that they are in the network could, any of those, develop products and distribute them to that platform. And then from there, you start thinking about what else was possible to do. So we created JP Morgan Coin, which is essentially used for several companies around the world to optimize their flow of payments with their accounts around the world. So liquidity, and it is expensive, it's going to become even more expensive, so it makes a 24/7 platform to optimize that. We work with the Monetary Authority of Singapore, DBS, Standard Chartered, Temasek, to create a network of payments 24/7 to process payments in dollars and in Sing dollars that we're about to launch, and over time it will be more and more payments. And as time goes by, digitalization of securities, tokenization of deposits, that is coming. And as it comes in, you realize they're going to face the challenge of having to operate in a public blockchain instead of in a private one. So therefore, we are working on tokenizing identity to be able to be in that open environment in a secure way. So we are at the very, very beginning of the journey here, but what it feels to me, even though it's been very slow over a period of time, I think that this is the time where this type of technology, these type of use cases, they are going to really accelerate substantially.
Thank you. Now to Rob. So you have Aladdin, and Aladdin has worked with Coinbase, which is a very major crypto exchange. For collaborations, and at the same time, you have invested in the stablecoin exchange called Circle. So share some thoughts, behind those investment and those, partnerships.
So let me pick up where Daniel left off. So I think in talking about this, we have to be very careful about the terms that we use: blockchain, crypto, cryptocurrency. All of these things have very, very long stories and are very complicated, but it's all in the same thing to digitize the financials ecosystem. And so everybody in this room is going to be part of this in one way or another. And I think that my colleagues represented here are already pretty far down the path in something that's pretty new. We have a risk system, which I see some people in this room that actually participate in it, called Aladdin. And we have noticed over the past couple of years that the growth of digital assets and the blockchain, what we'll call ecosystem, is really starting to pick up pace. And what happens is I start to see an increase from our clients in wanting to invest, as well as internally from my technology department to want to understand the applications for our entire industry. So I do believe that digital assets and blockchain technologies are going to become very relevant for asset managers like BlackRock and our clients. It's going to involve how we choose to manage portfolios. More importantly, how we interact with my colleagues on the stage, and of course, how we operate in the new markets ecosystem. So what have we done? I look around here. I have spent a lot of time with everyone here trying to understand where they are and what their research is, from the exchanges to the banks to the other asset managers. The one thing I can tell you is everyone's spending a lot of money on trying to figure this out. So we have taken a series of steps. It's driven by client demand, the technology, as I mentioned, and I believe the maturation of the crypto asset ecosystem. There's a new word that we can use. So what did we do? We created a partnership with a company called Coinbase. You're probably an original investor in that, if I know you.
Unfortunately, I don't.
I'm sure. To provide common clients of Aladdin and Coinbase access to digital asset trading life cycles within the Aladdin workflows. So today, Aladdin clients who hold crypto exposures are only able to go through processes that take place outside of the integrated Aladdin platform. And so this integration that we're going to do supports Aladdin's core mission, which is to provide solutions that support a whole portfolio. So by connecting Coinbase's comprehensive trading, custody, prime brokerage, and reporting, we're going to take those capabilities and put them into Aladdin workflows so common clients can manage their crypto exposures alongside of what you mentioned, Daniel, the public and private investments, enabling what we will call an efficient operating model and risk controls. So this is looking at the technological part of what we call crypto through a company called Coinbase, which has really built some incredible rails that are different and more efficient than the current rails that we currently use. And then the second thing is I created a minority investment in a company called Circle, and they are the issuer of USDC. That is a dollar-based, fully reserved stablecoin. And with that investment, there's currently 45 billion of USDC in circulation already, of which, through my partnership, we're the primary manager of the assets backing USDC. So I think that stable coins have a real potential to drive efficiencies and disruption across payments and capital markets activities. So we're working with Circle now to explore those opportunities where we may be able to enhance financial inclusion in the payments domain, enable frictionless real-time settlement with the capital markets, which is really quite astonishing that we can move money in a second without posting collateral, which will change, again, the ecosystem and the efficiency and the cost to our clients, and also increase the efficiency with my colleagues here of how we interact going forward. So there'll be more to come on this.
Thank you, Rob. So you talk about Coinbase. Indeed, this is one of very, very few crypto exchanges which has largely complied with regulators globally. Now, regulators has looking at this technology and asset very closely. And one thing, other than stablecoin, they have been developing is obviously CBDC. This is obviously creating a lot of impact to the banking industry. So my question is to Noah and to Bill, so what does CBDC mean for you? Is this good or bad? I mean, I think the Hong Kong dollar is very much a CBDC. So we'd love to hear your comments.
It's good. And let me give you a bit of context. Last year, HSBC moved around $660 trillion of money around the world. 98% of that was straight-through process, digital execution. Now, so digitization of banking is happening and has been happening for many years. In fact, if I go back through the archives of HSBC, the first digital banking platform for treasurers was probably launched about 30 years ago, called Hexagon. It then morphed into version 2 called HSBC Net, and it's now on version 3 on our technology base. So digitization has been happening for a long time. If I look at CBDC, digitization of real-time payments in domestic sort of retail banking has happened around the world over the past 5 years. And therefore, there's a questionable case for CBDC because real-time execution and transfer of liquidity from one customer to another in a domestic market's good. It's happening. However, real-time payments for consumers and businesses cross-border is not yet happening. It can happen within a banking network. So each of us here can move money to our clients real-time overseas if they're in the network of the bank. But going outside of that network, I think there's a big role for CBDC and blockchain to actually effect real-time movements of money cross-border, low cost, immediate transfer of funds. And I see blockchain as a great piece of technology to satisfy that requirement, and that's why I know Bill and ourselves are working with Eddie here to bring CBDC out of the concept into the reality. Pilots already run, and I think that can be a big impact for small and medium-sized businesses to get the benefits of real-time movement of money cross-border that the large corporates get today. And I think that can unlock and facilitate international trade. And credit to the HKMA for putting that collection of countries together to bring this to market as a real solution rather than just a concept. Now, blockchain more generally, we did our first trade execution on blockchain probably about 4 years ago. Blockchain is a technology base.
Which sector? Can you share some a little bit detail?
We did the first trade here. I think it was a trade between Asia and the Middle East, a real-time trade, not a pilot trade, executed on blockchain. So blockchain as a technology has a place, but it's not the only technology to solve some of our digitization solutions or problems.
Thank you. Bill?
I think each of Noel, Daniel, Rob covered a lot of ground. I think one of the interesting questions is why the world needs CBDCs as well as the stable coins that Rob was talking about. Circle was the example, of course, there are others. and they're gaining tremendous traction. The CBDCs, some would argue, are a response to private sector stablecoins. The fear that monetary policy was going to be wrenched away from central banks and that the money flows would be less visible to central banks than would otherwise be the case. And that in and of itself is a motivation for CBDCs to exist. But it's probably not a good motivation for a CBDC to thrive, because at the end of the day, if you talk to Rob's colleagues at Circle, they spend their days and nights thinking about how to embed themselves in the digital economy and how to make the customer experience a better customer experience. And as much as I love central bankers, they don't wake up and go to bed at night thinking about the customer experience. They wake up and go to bed at night thinking about financial stability and monetary policy and economic growth, things that are critically important. So the key for me is I think these things can coexist. We know that through regulation, CBDCs can not just displace stable coins, they can displace banks. I don't think Eddie wants to be in the credit intermediation business in a major way, and I haven't heard that from any other central bank either. So there's always going to be some, well, I hope there will be some guardrails on the amount of CBDC that is in issuance, because those are deposits that will not be in banks. Right? That's the nature of a CBDC. So I think that there's some really fascinating and thorny questions. How do you get to the customer use case most effectively? What's the role that a central bank should play in that? And how does that interact with the primary functions of a central bank around financial and monetary stability? There's a solution to, there's a nexus around those various questions. And I think central bankers are approaching it very, very, very thoughtfully. I think there are other use cases. There are surveillance use cases. There are financial crime use cases or fighting financial crime use cases, which run counter to some other objectives that we've got around free flow of information in markets and transparency. I think these are extremely vexing questions that will be tackled by some central banks, not all. And we're at a super early stage in this process. But I think at the end of the day, if we get a better customer experience and less friction costs, very much to Noel's point, this can be a successful venture and can coexist private and public sector.
Thank you, Bill. And then we're going to turn to the role of digital technology in banking. So back 3 years ago, the Hong Kong Monetary Authority gave out 8 virtual banking licenses. One of them is Mox, which is a subsidiary of Standard Chartered. So I'm going to lead the question with you again, Bill, that how this experience so far, how is Mox doing? And you also have your own online banking. So are you worried about cannibalizations between your subsidiary like this versus your own operations?
So first of all, I'll say we are extremely grateful to the HKMA for having given us a digital banking license. That was a big experiment in the beginning. I think it's an experiment that's worked well for the population in Hong Kong. Mox, and we built our first de novo digital bank called Mox in Hong Kong. We've now replicated that in Singapore with a bank called Trust. You're correct that we control Mox in that we own 65% of it, but we have Mox is a partnership between Standard Chartered, Hong Kong Telecom, and Trip.com, the Hong Kong Telecom Group, which includes FWD and others. So it's been extremely successful so far. It's certainly relative to our expectations. 400,000 customers. We've got a full range of deposit, savings, credit card, soon to be credit, and wealth products. It's got the top app store ratings of a financial services app in the world and has maintained that position for 2 years, and it's gaining tremendous momentum. We expect that it will break even sometime towards the end of next year or early 2024, which for a digital bank, standalone, is pretty good. Why is that possible? Well, it's not because our deposits are different than Knoll's deposits, or for that matter, the deposits sitting in Standard Chartered Bank. A deposit's a deposit, a loan's a loan, a credit card's a credit card. Yeah, we can play around with reward points and all that, and we do. The difference has to be the customer experience, again, but two, the nature of the partnership. So in Hong Kong, the partnership with Hong Kong Tel and Trip, largest online travel agent in the world, obviously not the best time to partner with an online travel agent, but it will be, right? And we're all evidence of that.
Thank you for that comment. Actually, I'm a co-founder of C-Trip.
I know that.
So, I think I'm very glad that oftentimes when I opened the trip.com Hong Kong, I saw the Mox popping up. So,
and you have a Mox account, Neil?
Have not.
You
need to convert me into.
I'll see you afterwards.
Okay.
But no, in Trust Bank in Singapore, which has also added 400,000 customers, but in that case, in just a couple of months, far exceeding our expectations, with an equal balance of credit and current account subscriptions. Our partner is the FairPrice Group, which is the ubiquitous grocery store chain in Singapore. Every Singaporean touches the FairPrice Group every day, once or twice. And so what's different about the virtual banks is the nature of the coalitions and partnerships that you can create, rather than the nature of the banking product itself. Although, of course, if the banking product is no good, nobody's going to use it. So yeah, it's been a huge success for us. We'll continue. We've got 9 digital banks in Africa. We've taken a different route in markets like Korea, where we helped build Toss Bank, and in Taiwan, where we helped build Line Bank. We're a minority shareholder there, not controlling, but very, very successful banks with a couple of million customers apiece, et cetera, et cetera. So I do think that it's an alternative to conventional banking. You asked, is it a problem that we're cannibalizing our own business?
Yeah. Are the two products really the same, or there are very different customer base, or
We've targeted the Mox product at younger customers, although interestingly, it's been taken up as much by people my age as it has been by people in their 30s. It's a little bit more mass market product, and Standard Chartered is a bit more of an affluent-oriented bank. But yeah, of course, we're cannibalizing ourselves, and I can tell you it's made Standard Chartered Bank better by virtue of that.
Thank you. So you are very happy with the partnerships, and you are replicate that to other, Yeah. Great. So the next question will be, given to both Noah and to Daniel. So when you look at the whole digital banking, there are some new entrants, and one of those are the so-called big tech companies, whether it's the Alibaba or the Google of the world, or whether some startup companies, for example, New Bank from Latin America. So those are called the challenge banks. Are you worried about those competitors, which has really so-called mobile-centric and mobile-native startups, and they have some wonderful technology and claim that they can change the whole banking industry. So what's your take on these competitors?
So when I look at the retail business, so the model that really has worked the best so far is the hybrid model, where you have optimized branch network and provide amazing digital services to your customers, and you use both. And that is a model that we follow in the United States, extremely successful. 65 million customers, 18% market share in credit cards, 11% of the national deposits, million small business that we cover. There is no doubt that the big platforms will go into that space and compete. Also no doubt that to replicate that model somewhere else is impossible, because it will take billions and billions of dollars over such a long period of time that it will really make the journey almost impossible for any bank, regardless of the size. So then we thought, so how we are going to diversify our business by growing outside the United States? And the answer was digital. And we chosen the United Kingdom, a market that we know, and we launched Chase in the UK, a pure digital bank. We were expecting to find 500 customers In the first year, we have over 1 million, 12 billion pounds of deposits, and it's growing very, very well. We are completing the services there. There is a very, very good take. And the reason why I feel that we can compete in that space with the digital banks is the recognition of the brand, number one, the strength of the balance sheet of JP Morgan Chase that give the confidence to customers to leave more money with us than they will do probably with a digital banks. And since we are starting from zero, we have created a brand new modern platform that gives us the ability to develop an amazing customer experience. So on top of that, we bought Nutmeg, which is a digital wealth management that we are going to incorporate in our platform. And also the third biggest retail banker in the world is Brazil. So we bought 40% of a bank, digital bank called C6. We have a path to buy more if we decide to do so. When we started talking to them, they have 5 million customers. A year or year and a half after, they got to 17 million customers. And a full platform, all the services, wealth management, small business, lending, and savings. So I think that we will see how the journey goes. So far, we think that is doing better than we were expecting. There is a role for other types of digital banks. We are a challenge for them and for us as a pure digital bank is to get to the point of profitability. We are very new, we haven't got it, and many of those haven't got it to that point either. But so far, I think that the ability to a company like JP Morgan Chase to really be committed to it and continuously invest in the long term is very, very important and give us a competitive advantage.
Thank you. Noah?
Well, I think it's, as an established institution, you have to embrace the fintech sector. Competition's healthy in all markets. Every institution will take a different view on where to compete and who to compete with. But you've got to embrace fintech. So in that regard, we've invested about $700 million of our own money into a range of fintech-related businesses. And we're doing it primarily to actually learn and collaborate with them rather than just see it as a financial investment.
Sort of helping you to enable,
and bring that technology into the bank, so to continue our digitization journey of HSBC, and to learn and collaborate with them, make their business stronger, but bring capability into the bank as well. In terms of one particular journey we're on here in Hong Kong, we set up, one could argue, a cannibalization of some of our payments architecture here in Hong Kong with the PayMe infrastructure we built, which is providing a digital wallet solution between consumers and businesses. And we've now got 2.9 million people on that network, and we're growing the merchant base rapidly. And that, for us, was an important milestone for us to actually go in on a very different sort of banking solution. Clearly, we're a relationship bank at the heart. We provide services to both consumers, SMEs, and large, to corporates as well. But we embrace innovation and technology, and we thought it was important to build a digital wallet here in Hong Kong. And we're getting close to 50% market share of the consumer base here in Hong Kong after about 3 years of building that. So that's good. The next stage for us then is how do you innovate that model elsewhere? How do you take that model to other places? So my message on fintech is competition's healthy. It's everywhere, every market you operate in, and embrace it.
Thank you. So back to Rob. So, you mentioned actually just now about Aladdin, which is a wonderful analytical tools. And this is pretty amazing because, you are one of the largest asset managers in the world, but you incubate this internally and develop as a great, new business line. And it's actually offered to your customers, yourself, as well as to your competitors. So tell me a little bit of how this gets, developed internally as an important technology tools.
Well, I think these days everybody wants to be a technology company. So if you read any bank's or asset manager's earnings report, it's going to say that they're investing in technology. We're reinventing ourselves through digital capabilities. So we're very supportive of that mindset. We've been doing this for the last 30 years. Believe it or not, when we started the firm, I would never think I would have an artificial intelligence lab. We have citizen developers on investment teams using APIs and advanced data science capabilities to build a portfolio. And we also have $1.3 billion a year coming in through our fintech business, which grew north of 10% again last year. So the one thing I know about technology in every asset manager or financial services firm, there's one thing in common. They have an endless list of things to do. So increasingly, what is happening is the world's largest investors really want to focus their time, energy, and resources on true points of differentiation, which is what my colleagues here talked about, how they're going to navigate the markets, how they're going to generate performance, and how they're going to manage client relationships. But for everything in between, especially having a scaled investment technology, they really just want access to the best. And they don't want to recreate the wheel. And that's where Aladdin has come in. So since the very beginning, Aladdin is our proprietary risk management platform. It's been one of our foundations that separates us. And the portfolio managers of BlackRock are Aladdin's biggest users. So we view this user-provider model as one of the principles of Aladdin and something that does differentiate us from others, as you mentioned. But at the end of the day, both asset management and technology solutions are businesses that are based in trust, as was said in the previous panel. And our clients have put their trust in us to put their best interests first, and what we are applying is the fiduciary mindset of which side of the business they're on. So the way I would describe it to you is Aladdin is a tech platform that unifies the investment management process. So beyond enabling better risk analytics, it's created a highly efficient and integrated model and an integrated solution that allowed us to scale and grow, and unified employees because we work from one database. There's only one number that they can use across the firm. There's only one language that they could use across the firm. And we have a shared process and a common system. So we took this decision many years ago. It was a big argument of what we should do. And we took this decision to make it available to clients as a service provider. And it's continued to develop over time in response to their needs. Now, I have to say, and I always write it down, to be clear, Aladdin does not make investment decisions. It does not perform roles of an investment professional, nor does it make decisions for any professional in the process. It just enables investment professionals to conduct their work more easily by enabling quick access to the information that they need to make and execute on their own decisions based on their firm's objectives and decision-making frameworks. So lastly, and to be very direct, each Aladdin client has their own customized version of Aladdin. That's how we do it. So their version of Aladdin is hosted in a dedicated environment, segregated, and protected from other Aladdin clients, including BlackRock. So technology now has enabled us to provide more choice to our clients. We're able to provide clients with differentiated analytics on their whole portfolio. So as we grow, the clients' demands are changing. They're looking for new products, strategies, solutions. Aladdin is going to continue to grow and provide more value because the markets are growing, the products are growing, the ecosystem is behind, and we have to catch up. And Aladdin is enabling many people in this room, and certainly BlackRock, to help keep track of that.
Thanks, Rob. Crystal clear on neutrality of the ratings. So. You did touch upon this point of AI and big data. So I'm going to go to Noah, because you have a lot of data. We know in the technology world, having data is great, but also having data can creating a lot of inherent tensions. You know, the startup versus the traditional financial service company look at data very differently. I think, you know, the client privacy oftentimes conflict with their demand for a tailored product. And then also there's a compliance issue, which also could conflict with the demand for pulling data from multiple channels and resources. I know you have been collaborating with Google, the very leading big data company, the AI company, you know, in the digital space. And how is that partnership come along? And what is HSBC try to get from this partnership?
Yeah, thanks, Neil. And let me just clarify. I mean, if you look at payments, if you look at a bank like ourselves or JP Morgan or Standard Chartered, we have a huge amount of payments data, huge amount of trade data, huge amount of foreign exchange data and client data. Now, one of the biggest challenges for an international company is when you're moving significant amounts of money and goods around the world is making sure you're detecting fraud and inappropriate financial crime. And that's where the power of AI comes into play, because what you're trying to do is to take that fraud detection, financial crime detection methodology onto the next level. Instead of using simple algorithms or even complex algorithms, you're trying to take it to the next level. And what we're doing is partnering with Google to try and build the next generation of essentially sophisticated analytics using AI techniques to detect patterns of behavior that could could suggest there is fraudulent or financial crime activity taking place. And that's particularly important because the level of sophistication of determined actors in that space is increasing by the week and by the month, because they're using the same techniques, they're using the same capabilities. Now, in building those models, in building that AI, you're not contravening any data privacy issues, because you retain the encryption key, you retain the capability, you're using the tools, but it's not being used in letting customer data go outside of a data privacy wall. But you're using the analytics capability to try and really get sophisticated modeling and detection capabilities for fraud and for financial crime. And that's what we're doing. But I'll be surprised if our competitors in the room today aren't doing a similar thing. And I know from a regulatory point of view, all regulators around the world are keen for the financial system to keep upgrading its capability to make sure it has the ability to detect inappropriate behavior. So that's the primary use. Using AI for other reasons, you may have different considerations on privacy and use of data, but when you're fighting financial crime and fraud, I think you've got to keep going to the next level of sophistication.
Thank you. So same question to Daniel and to Bill. So how is AI and big data being used in your customer services and offerings?
So it's been a long journey too. So one of the, obviously, like everyone else, we set up our research labs of artificial intelligence, and we have a center of excellence and all that. But for this technology really to be powerful, like anything else, you need people to use it. And then you need to really teach the organization the power of this technology to have more and more and more use cases. And as time goes by, there are more and more use cases coming along. I will mention a few. Markets, the fixed income trading and equities trading. More and more, we are moving from rule-based algorithms that are very simple and execute whatever you give the constraints to smart algorithms that they are quoting transactions to clients and doing the risk management and executing in the market. So we do it for several asset classes at the moment. So fraud, Noel mentioned about fraud. When you have, no matter how sophisticated a normal algorithm is, you're going to have a huge amount of false positives. What AI comes into is to really reduce those number of false positives and create the number of cases that people have to investigate to be a lot smaller than it would have been otherwise. And in the retail business is really fascinating, all the things that we are doing. I'll give you an example. So call centers, we have call centers around the world. Today, when a customer calls, so he talks, that person talked to one of the people in the call center. As the conversation goes, the machine is listening to that conversation and providing feedback to our employee of what would be the possible solutions to the problem that customer is calling for, reducing the amount of time to solve that problem substantially. And we are using it in many other cases, offers. So in the retail business, instead of being bombarded with things that you will never do or will never consume, is more help us to target it. So there are many, many applications that is evolving every day. But the good thing that I feel, at least in our company, is now just become more mainstream. So everyone in the company knows the power of this technology. And when they think about customer solutions, the AI machine learning component of it comes quite natural, and it wasn't the case a few years ago.
Bill?
If I could just try to build on the excellent comments from Noel and Daniel. Each of them talked about the way that we're getting more sophisticated using data that's in-house. To me, one of the really interesting frontiers is how we incorporate data that's coming from the network, from outside. And maybe to pick on one of Noel's examples around financial crime. In fact, the three of our firms have worked together in various efforts to use the data that we have across our 3+++ firms to identify patterns of cross-bank behavior that indicate financial crime. We brought down some really serious human trafficking rings, for example, through the use of a coordinated attempt at taking all these tools that Noel and Daniel have talked about and applying them not just to our own data sets, but to the data sets that exist in terms of payment flows between banks, or eventually between banks and our customers. The second network effect that's critical for us is maybe getting back to, Neil, some of the questions you asked about the way partnerships work. There's always an exchange of data in a partnership, and the data is orthogonal. I mean, the data that we get from Hong Kong Tel or from Bukalapak in Indonesia, our partner there, largest e-commerce platform, it's very different data than the data that we get ourselves. The data that we have is very different data than they have, and the combination of that data, of course, respecting all the inherent privacy requirements and restrictions, it's exponentially more valuable than the data that one side or the other has. So I think that the next frontier is how we create, in an appropriately guardrailed and ring-fenced sort of way, how we create these data networks that are fundamentally more valuable than the data that we ourselves have. Added benefit of that is that a bank that isn't as big as HSBC or JP Morgan can actually compete directly, because we have natural data partners that will want to deal with a bank that's a little bit smaller rather than a bank that's a little bit bigger. And I'm not saying, like, my objective isn't to compete with Noel and Daniel sometimes. But obviously, we do much more together, frankly, than we do competing with each other. But the use of data, the use of data networks, is a fundamental leveler of the playing field, which I think is good for competition and therefore good for consumers, good for societies.
I think Bill's trying to get me to open a Mox account.
You're most welcome.
Okay. Well, thank you. One last question before I open the floor. I just think we have 4 or 5 minutes to go. This is a quick one. So globally, the regulators are all looking at crypto and blockchain. And clearly, the regulators are stepping up their efforts to put this into their regulatory scope, right? So as leading financial service company, what the advice you give to the regulators, or what do you expect that they could do to, one, make sure this market continue to grow healthily? Second, there will be great protection for customers. Anyone?
Yeah, my only advice to regulators is to the cryptocurrencies, and you're talking about non-fiat currencies here as opposed to the digital, the stable coins and things like that. Bring it into the system, don't leave it out. Bring it into the system, you can watch it, observe it, understand where it's getting, where speculative bubbles are building. Leaving it outside, it's going to be very hard to control. It's not going to go away because regulators wish it away. So I think the proactive approach that the HKMA is taking is exactly the right one. I know you're going to be cautious about how you do that, and you should be. But the opportunity to bring this into the system, I think, is correct.
I think if you look at the technology that crypto is based on, the technology is not the thing to regulate. Technology should be free to innovate. When that technology produces a product that becomes an asset class, which pure crypto has become an asset class, there's a strong argument to say, and particularly when that asset class is being bought by the mass market, then there's an argument it should come into the regulatory environment. If it's a technology facilitating payments, that's different. If it's a technology that becomes an asset class, and that one asset class is unregulated, but all other asset classes are regulated, it feels strange to me.
Okay.
So clearly, it's a very highly speculated small asset class as it stands at the moment. And I agree with Bill and Noel. So if you look at how regulation is trending today, is towards particularly the crypto assets, the non-fiat crypto assets, they are going to be left outside the banking sector because the capital rules that they're putting in place are quite punitive for any regulated entity like a bank to participate. So probably regulators should reconsider that and say that it's safer for the consumers to operate with regulated entities as they do all the other financial services need. But at the moment, the trend is not coming this way.
So instead of investing in it directly, you should have it professionally managed. Is that what you want me to say? I think it has to mature more, and we're not there
Before,
yet.
okay.
Yes.
Good. So I think we're running out of time. Just one question for the floor, if any. All right. Looks like we're all set here. So let's give a round of applause to this wonderful panelists for sharing the insights on tech. Thank you. Thank you.
And thank you, of course, Neil Shen. Great job on moderation today. Gentlemen, if you could move to the center of the stage for a photo. We're not going to let you get away that easily. There we go. Don't want to miss out on a gathering of those handsome mugs. All right, thank you very much. I would like to share with you a little something personal, something kind of strange that happened to me recently. I've lived in Hong Kong for 26 years now. I got here 1996. And when you live in Hong Kong for a long time, you notice something that I think is almost unique to this city. There are these birds birds of prey, raptors. They're called black kites that hover over the city. You can almost always see one somewhere up there riding the thermals, but they're always far away. It's almost like they never land. You never see one up close. You wonder if they just disappear at night and come back in the morning up high in the sky. So about a week ago, we were having a meeting at the 55th floor of IFC2 at the other end of this complex, a meeting at the Hong Kong Monetary Authority offices planning this meeting. And while we were having the meeting, as we were wrapping up, one of these birds, almost mythical birds, the black kite, came and lit outside of our meeting. And he didn't stop and fly away again immediately. Stopped and stayed. Didn't appear to be doing anything, just supervising our proceedings, keeping an eye on us. And it was really special, not just for me, but also for the people who work at the heights of IFC2 at the HKMA. They said they had never seen anything like this before. It was quite rare and special. And we took it as an omen that this was a sign that Hong Kong is taking off again. So we were quite excited by this. He stayed around so we could all take photos. This black kite was very gracious and bestowed his blessings on us that we were happy to have. Someone who I also know thinks that Hong Kong is taking off yet again is someone who moved to heaven and earth to be here with us today. Heaven and earth and maybe a lot of sand that he kicked out of his shoes on the way in here. We now welcome the Financial Secretary of the Hong Kong Special Administrative Region of the People's Republic of China. Please welcome Mr. Paul Chan.
Distinguished speakers and guests, ladies and gentlemen, good afternoon. It has been a brimful and hope rewarding day for all of you so far. The rewards will continue with a fine lunch from Eddie in just a few minutes. In the meantime, I'm here to sharpen your appetite for Hong Kong business and investment. Looking to the future, the potential and opportunities of Hong Kong as an IFC is just boundless, thanks to the unique connectivity with the mainland and the world. We are determined to excel in many areas. Among them, our fundraising platforms, our role in renminbi internationalization, the unique connect schemes with the mainland, asset and wealth management, Center for Risk and Corporate Treasury Management, and much more. The list could be long. But to echo this morning's inspiring panel discussions, please allow me to highlight Hong Kong's development in just two areas: green and sustainable finance and fintech. Around the globe, governments have been drawing up action plans to peak gashouse emission and achieve carbon neutrality, seeking to reach the targets in the Paris Agreement. The mainland has set out its 30-60 dual carbon targets, that is, peaking carbon emissions by 2030 and achieving carbon neutrality by 2060. And in Hong Kong, we set our target to reach carbon neutrality by 2050. Along the global momentum, Hong Kong has this vision: to become a premier center for green and sustainable finance that serves the green transformation in the mainland, the region, and the world. On this, we have much confidence. The National 14th Five-Year Plan supports Hong Kong's development into a green finance center. In particular, Hong Kong's strategic position in the Guangdong, Hong Kong, Macau Greater Bay Area, where green transition is high on demand. For this burgeoning 11-city region, with a population of 86 million. Adherence to high international standards is also why we have good prospect to succeed. We have reporting and disclosure standards that align with international best practices. We are seeking to adopt a green classification framework along the common ground taxonomy. Green bonds issued in Hong Kong are trusted by global investors. In realizing this vision, we lead by example. We issue government green bonds since 2018. Through the concerted efforts of regulators and the industry, green and sustainable debts issued or arranged in Hong Kong reached more than $56 billion in 2021, 4 times that of the previous year and topped in Asia. Deep liquidity aside, the market covered a diversified investor base and project categories. We continue to provide expensive subsidy for eligible issuers and borrowers for their borrowings in Hong Kong. In many ways, we are setting benchmarks and standards for green finance in this region. Last year, we became the first Asian government to issue 30-year and 20-year green bonds denominated in US dollar and euro, which were the longest tenure of Asia government bonds at the time. The response from investors were overwhelming. Mainland provincial and municipal governments are supporting our efforts as well. Shenzhen, our neighboring city, was the first mover, and they issued their first ever offshore renminbi green bonds worth 3.9 billion renminbi in Hong Kong last year. It was followed by the provincial government of Hainan, which announced just last week the issuance of blue and sustainable bonds worth 5 billion renminbi in Hong Kong for marine and sustainable projects. Green finance seeks to support humanity's responsibility for the environment. And we do not forget that this is what our people should own and benefit from. In May this year, we issued the inaugural retail green bonds to the order of $2.5 billion, which is also the largest globally. The costs are slightly more expensive and administration a little more burdensome, but it will reinforce our residents' sense of ownership of our green vision and help us achieve financial inclusion goals. Allow me now to turn to the future of finance. The key word to this is definitely fintech. Hong Kong's strength as an IFC and as part of GBA facilitate our development of a strong fintech sector. We have an extensive presence of top global financial institutions here, providing a complete range of financial services, a deep pool of financial expertise and talents, an internationally recognized regulatory regime, and sophisticated IT infrastructure, etc. Building on this foundation, we have been adopting a multi-pronged approach in fostering fintech development. They include, first, forward-looking and facilitating policies and measures. For example, a FinTech 2025 strategy has been promulgated by the Hong Kong MA to help all banks to go fintech. Sandboxes of all the financial regulators are linked up to facilitate development of cross-sectoral fintech solutions. 2, encourage innovation. For example, we issue on Monday a policy statement on virtual assets. We make our policy stance clear to the markets to demonstrate our determination to explore financial innovation together with the global VA community. Third, development of essential infrastructure. For example, a faster payment system connecting all bank accounts and electronic wallets for individuals, enabling them to make instant transfer between all these accounts and between individuals. The commercial data interchange allows businesses to share operational data on a consent basis so the banks may make better informed assessments of loan applications, while SMEs may have access to financial services more conveniently. Fourth, leveraging on our unique superconnector role to facilitate cross-boundary collaboration in the development and application of fintech solutions. Cross-boundary supervisory sandbox in the GBA is a recent example. Besides, an online platform will be launched to connect Hong Kong fintech companies to users, partners, and investors in the mainland, Southeast Asia, and beyond. Meanwhile, the Hong Kong MA is also working with the Bank of International Settlements and 3 peer central banks on the M-Bridge project, exploring the use of CBDC to expedite cross-border trade settlements. Fifth, capacity building. We ensure there are facilitating and welcoming policies to attract mainland and overseas talents, while providing subsidized training and education opportunities for our own locals. Fintech qualifications have been established under the qualification framework so as to provide a clear career path to fintech practitioners. The recent policy address of the Chief Executive has also rolled out even bolder measures to attract talents. The sixth, nurturing the ecosystem. We provide subsidies for firms in their technology adoption, provide incentive for startups and private equity firms to establish here. And we have set up funds to support and invest in fintech companies at varying degree of development. Last year, we rolled out an electronic consumption voucher scheme. As a result, consumer accounts and merchant accounts of the relevant store value facility operators have increased by more than 8 million and 150,000 respectively from the year before. Application of electronic payment has now infiltrated into different businesses and walks of life, from shopping centers to wet markets, from hawkers to taxi drivers. We have come a long way in a short time. 5 years ago, Hong Kong counted no more than 180 fintech companies. Today, we are home to more than 800 companies. Many of them are founded by entrepreneurs from the mainland, France, the UK, and the other places. We have also nurtured several local unicorns. But we do not stop here. The virtual asset policy statement mentioned earlier sets out our vision, regulations, thoughts on investor protection, and attempts in emerging areas such as NFT tokenization and e-Hong Kong dollar. As an IFC, Hong Kong is open and inclusive towards global innovators. We are working with the financial regulators towards providing a facilitating environment for the sustainable and responsible development of the virtual asset sector in Hong Kong. Ladies and gentlemen, in short, our prospect of green and sustainable finance and of fintech are highly promising. But before I keep you further from your lunch, may I express thanks to the Hong Kong Monetary Authority for organizing this inspiring and thought-provoking summit. My thanks too for your participation, for your unwavering belief in Hong Kong. Thank you very much.
Thank you very much, Mr. Financial Secretary Paul Chan, for joining us today. Ladies and gentlemen, a lot of you last night, as I mentioned earlier, thank you. As I mentioned earlier, a lot of you were at the M+ dinner last night. It's a fantastic institution, new to Hong Kong. I've been, I love it. And we have a special video to bring you back to some of the memories from last night. Thank you. And that was you. And with that, ladies and gentlemen, we are going to be having lunch, appetizers, mains, all on the way, but we are going to be having a really spectacular fireside chat over dessert later on, so I will leave it with bon appétit. Merci.